Yahoo Finance this Wednesday, June 12th. I'm Julie Hyman with Josh Lipton, and we are moments away from the Fed's decision on interest rates. We are seeing upward movement in the equity markets ahead of that. Remember, the S&P and the Nasdaq closed at records yesterday, so any gain today will be record closes once again. But they're gaining with a comfortable margin, at least right now. As we know, Josh, anything could change once we get not so much the decision, no cuts expected, but the dot plot and then the press conference.
So it's interesting because yes, obviously you expect the Fed to hold steady here, but there's kind of some interesting storylines, Julie, which developed this morning with that CPI print, which was good, and it was your second good print. Because remember, in the start of the year, we had these other kinds of prints that kind of threw everybody for a loop, including, by the way, our central bankers seemed kind of caught off guard. It turns out maybe that was more seasonality than anything else. And now you've had this morning, cooler than expected. That's your second good print. So it's sort of interesting as you head into the meeting. How does Jay Powell and the Fed, how are they thinking about that and and what that means for inflation and just the trajectory of inflation ahead?
Yeah, I saw multiple economists characterize the data this morning as giving the Fed, allowing the Fed to breathe a sigh of relief, that we were seeing more signs of deceleration in inflation, or disinflation, as some folks like to call it. Be that as it may, I suspect we will hear Jay Powell say some version of, we need to hear more good data, which is something that he has said before. This is great. Today is great. It's a step in the right direction, but we need more of this to make a trend and to allow the Fed to begin cutting. But it looks like people are now pricing in a higher likelihood of it happening later this year.
I also saw some economists betting that maybe the cuts go from 3 to 2, maybe even 1. Although the 1 camp seemed a little less likely. So that was another big theme today, too. But very interesting.
But the odds of the cuts coming, even in September, have gone up after the data that we got this morning. Now I'm going to send it to our Jennifer Schonberger with the details.
No change. The Federal Reserve holding rates steady in the range of 5.25% to 5.5%, but scaling back the number of rate cuts this year to 1 from 3. Though it was a very close call because 8 officials saw 2 cuts this year, while 7 saw 1 and 4 saw no cuts at all. Next year, officials have revised the number of cuts to 4 from 3 previously. This as officials raised their inflation forecast for this year to 2.8% from 2.6% previously, and changed key language in the statement from saying that there had been a lack of further progress towards the committee's 2% inflation target to there has been, quote, modest further progress. Now, officials again stated that they won't cut rates until they gain greater confidence that inflation is moving back to their 2% target. Now, the neutral rate, that's the rate that neither boosts nor slows growth, that was revised higher to 2.8% from 2.6% previously. Officials retained their outlook for the unemployment rate at 4%, which is the prevailing rate for unemployment right now, and they also retained their outlook for GDP at 2.1%. This decision was unanimous. Back to you.
Jen, let me get your take. I mean, listen, you know the Fed backwards and forwards. They hold rates steady. We expected that. They do indicate, as you noted, only one cut coming this year. So that's a change. As you read through this, Jennifer, what surprises you in this statement?
I think, Josh, if we look at the dot plot, there's a lot of division within the Fed. I mean, they were almost evenly split down the center. This could have easily been 2 cuts, right? There were 8 officials who saw cutting rates twice this year. And I think that CPI report that we got this morning probably influenced them because officials are able to make changes to their interest rate projections coming into that second day of the meeting. So it'll be interesting to see what Powell says during the Q&A here at 2:30, because he's going to have to walk the line of his colleagues. Is he a little bit more dovish? Which camp is he in? The 1, the 2? Probably not the 4 that say no cuts. The fact that we did see a change in language to now there's modest further progress from lack of further progress, I think that's a hat tip to this morning's CPI. Again, though, we're going to have to see more consecutive quarters of what we saw on CPI this morning for the Fed to feel comfortable to cut.
Jen, thank you so much. Appreciate it. So this language change, Julie, is interesting that Jen is calling out here. Inflation has eased over the past year, they say, but remains elevated. That's the post-meeting statement. So that's sort of like, that's mirroring language from the last statement. But then as Jen noted, you do have this more meaningful change As the statement follows, with this, in recent months, there has been modest further progress towards the committee's 2% inflation objective there.
Right, and interesting that they are bringing up their PCE forecast for this full year to 2.8% from 2.6%, taking down the number of cuts reflected in that so-called dot plot, what's formerly called the Summary of Economic Projections, to 1 cut this year from 3 cuts this year. So more in line with the market. And that's what, as we were talking to economists and other market watchers yesterday and reading a lot of the commentary today, that seemed to be in line with what they expected from the Federal Reserve here. So there are no sort of huge surprises that we are seeing at first blush in this. I mean, there was a little bit of debate. Would we get projections for 1 cut this year, 2 cuts this year, 1.5, something in between? So, but besides that, it doesn't seem like that there's anything that is sort of out of whack, for lack of a better term, versus what people were expecting.
Now it comes to Jay Powell. We'll listen for his comments, obviously. In the past, Jay is kind of, he's excited the markets once in a while, there. Julie's kind of got maybe off the cuff a couple times, although now he seems to sort of, just based on the last meeting, he played it a little, I wouldn't say conservative, but closer to the vest.
Yeah,
right?
and it's really funny. I was reading a commentary this morning from Krishna Guha, who is the Evercore ISI vice chair, and he said, quote, "The Fed chair does not always find it easy to hold back his inner dovish optimism,
interesting.
But we think he'll make a point this time of trying to strike a very careful tone at the press conference, so to sort of tamp down his inner dove, so to speak."
Makes sense. All right, well, let's take a look at the market action right now. I'm going to go to Yahoo Finance's Jared Blickery with a look there. Jared.
Hey, Josh. Well, we're not seeing the biggest movements in the indices just yet or the markets, but the fireworks are to come in a little bit. Let's take a look at what has happened today. You can see the Dow has just flipped negative, but just before the report, it was just barely positive. In fact, it gapped up this morning, and it's just trended down all day. FOMC drift in the opposite direction that usually happens. You can take a look at the Nasdaq, and this is a market which has stayed at its highs throughout the day, just barely a dip on that reaction when the report was released. And we'll take a look at the Russell 2000 too, which is the outperformer of the day, up over 2%, took a little dip there too. And then I want to hit the interest rates, and I'm going to show interest rate futures as traded on the CME. This shows this big reaction here. That was this morning at 8:30 a.m. on those CPI numbers. Now, that means that rates were going down because the futures were going up, so they move in opposite directions. Now we saw a little reaction to the downside, which means rate just went barely up. But for the most part, the big reaction today was based on CPI, and this confirms with a lot of other studies I've done, the Fed really hasn't been a factor in terms of moving the market on Fed days. It's been CPI, it's been the jobs report that has been doing that heavy lifting. Now let's take a look at gold futures, and this again is that CPI print. You can see we headed up at 8:30 a.m. this morning, came off, and then we tested those highs, and now we've come down a little bit off of them. So interesting price action there. And then we have copper futures, which were up on CPI and are just down a little bit on this report. I'll take one final look at the sector action before we head out here. XLK, XLRE, that's tech and real estate. Those have been the two leaders throughout the day, and they really haven't changed that much since the 2 p.m. report. So all in all, we'll be interested to see how Powell can move the markets when he takes the lectern at 2:30 p.m. Eastern.
That will be interesting indeed. It's quite rare that you see the XLK and the XLRE both in sharing those top spots. Thanks so much, Jared. Let's get more now on the Fed's latest decision to hold interest rates unchanged. For that, we get to Paul Donovan, UBS Global Wealth Management Chief Economist. Paul, it's great to see you. As you wrote in your note today, economists are overstimulated in the U.S. today. We had CPI this morning. We just had the Fed decision to not do anything with rates and the dot plot. We still have the press conference to come. How are you sort of synthesizing everything that's happened thus far today?
Well, to be perfectly honest, what we've been seeing was very much as expected. So the things that have been holding up CPI, they're not market forces. Your market prices are actually pushing CPI lower at the moment. It's weirdness in the seasonal adjustment. That's a legacy of the pandemic. The pandemic is still causing inflation to be higher at the start of the year and then lower later on because of weirdness in the seasonal adjustment process. And then this fiction of owner's equivalent rent, which is a price nobody pays. So we know that the underlying message is one of actually quite significant disinflation. That's lower inflation. And so the Fed today, no change. That was well transmitted. A unanimous decision is worryingly predictable. The fact that there doesn't seem to be a great deal of debate in the Fed over what should policy be doing is actually quite troubling, I think, because there is a real degree of uncertainty in the real world that the Fed should be paying attention to. The dot plots, frankly, I don't care. The dot plots are one of the worst ideas the Fed has ever had.
Why do you say, Paul, why do you say that? One of the worst ideas the Fed has ever had?
Because, okay, somebody said, right, I think there's going to be one cut. What probability have you got to that? 49% probability, 51% probability? It doesn't give a sense of the vagueness and of the complexity of policy decisions. To have a single black mark on a page doesn't tell you anything about the uncertainty, about the instability of the decision-making process. I think it's a really bad idea because it gives an illusion of certainty. And in a world this complex and frankly this messed up, we just don't have that degree of certainty.
Should they get rid of it, do you think? And any chance they will?
So I think almost every single former Fed official I have spoken to says, yes, they should get rid of it. But the problem is when you've come out and said that we're doing this for transparency, to then get rid of it seems to be a signal that actually we don't want transparency. So yes, as an economist, I think the world would be better off without the dot plots. But from a political perspective and from a messaging perspective, I think the spin around getting rid of it is probably too difficult to achieve now, sadly.
Paul, that CPI print came in this morning. Good print relative to expectations. That's 2 in a row. What is the read-through, Paul, of CPI to what the Fed is paying attention to, PCE?
Well, this is the thing. I think, back in June 2022, we had the major Powell policy errors where he surprises the market unnecessarily. And he also has elevated the importance of CPI. So the Fed economists keep saying, this is nonsense. CPI is a really bad quality statistic. The PCE is a better quality statistic, still with problems. But because Powell has elevated the CPI's importance, I think this does have a significant role to play. Now, there are links between CPI and the PCE. Of course, there are. You think they're measuring the same thing, but obviously they're not quite. The PCE plays less attention to the fantasy prices, things like motor insurance, which has been really weird in the CPI, is a bit more realistic in the PCE. So there is some feed through, but some of what we've been seeing in the lower CPI is simply the fantasy prices coming back closer to reality, and the PCE deflator is already at that reality.
So, Paul, what we like to ask folks sometimes is what you think the Fed should do versus what they are most likely to do in terms of the timing of that first cut.
Well, if you guys would let somebody with a British accent run the Fed, which you won't, I would be cutting already. I think the time for cuts is actually past. Bear in mind, the ECB cut rates with an identical inflation rate to the United States when you measure on a like-for-like basis. Look at harmonized inflation. The US, Europe, UK, they've all got the same inflation rate within 0.1% of each other. And the ECB has been cutting. The Bank of England is about to cut. I think they should have already started. However, here we are. I think September has to be on the cards. I think they should have enough evidence in the detail and the underlying inflation, the pressures. You've got a weakening labor market in the United States. You look across the broad indicators, the labor market is weakening. Doing nothing tightens policy further. Do you really want to be tightening policy further, raising real interest rates with a weakening labor market? The answer to me is fairly obvious. Of course you don't.
Well, the Bank of England had a head with a Canadian accent, and that went pretty well. So who knows? Maybe we'll try it out, Paul. Thanks a lot. Appreciate it.
Thank you.
Take care. Well, as we take a look at stocks, we are continuing to see them hold pretty steadily in rally mode, except for the Dow, actually, which is now dipping a little bit into the red here, very slightly. This all after the Federal Reserve's latest decision to keep interest rates steady. Of course, we could see more movement during the press conference, which is coming up in a little more than 15 minutes. In the meantime, we'll continue to break down the call on the other side as we await Fed President Jerome Powell's press conference. Stay tuned. More market domination still to come.
The Fed leaves rates unchanged, and we are moments away now from Fed Chair Jerome Powell's press conference. For more on the Fed's decision to hold rates steady and the future path for rate cuts, we have Larry Adam, Chief Investment Officer at Raymond James, along with Vishal Kanduja, co-head of Broad Markets Fixed Income at Morgan Stanley, joining us now to discuss. Guys, welcome both of you to the program. Larry, I'll start with you. We have the Fed decision. They hold rates steady. They indicate one rate cut this year. Larry, is that about what you expected?
Well, we thought you'd get two, so I'm a little bit disappointed by this number. I thought we'd get expectations for two cuts this year, and I'm surprised they lifted their inflation forecast for this year. You know, I thought we were getting some progress. Obviously, this morning's numbers showed that we were going to have continued progress in that, so it does surprise me. I think that's why the market is selling off just a bit here, really waiting on what Chairman Powell has to say at his press conference.
And Vishal, I know you think that today's meeting is quite pivotal, for sort of setting out the path for the second half of the year. What do you think we need to hear from the Fed today?
I think the biggest market assumption right now is that their next move is going to be into less restrictive policy. I think their statements over the entire bumpiness of the first quarter continue to have that basic assumption being reiterated from the statement, the minutes, as well as the Fed speak. And I think that's what we're hearing again, even though the first cut, again, the timing of the first cut seems to be getting pushed out, rightfully so, as the data has been uneven. You saw the Friday numbers of NFP telling you one story, and then the JOLTS number telling you another one. But then the CPI, as Adam pointed out, was definitely milder on that disinflationary path. So I think that basic assumption that the next move is going to be in less restrictive policy is what I would love to hear again from Chairman Powell at 2:30.
Larry, over to you. Same question. We're waiting now for Jay Powell coming up shortly here. What are you listening for, Larry? What are you going to be sort of listening for? And actually, let's say you had a question for him, Larry. What would it be?
How much confidence do you have in these actual forecasts, right? I mean, 6 months till the end of the year is still a long period of time. You already know how much it has already changed in just the first 5-6 months of this year. And I'd like to know what his confidence level is on those numbers, because what I see from my basis, on the ground, I do see inflationary prices coming down quite a bit. I see the fact that I'm seeing a lot more businesses starting to cut prices because, economic conditions are weakening. Just look at the CPI report this morning, right? You saw a lot of the more cyclical areas of this economy starting to show signs of struggle. Airfares, apparel, oil prices, new car prices. And I think the Fed's got to be careful not to wait too long before they start to cut the prices. So I would ask him, what kind of data is he seeing on the ground to really suggest that this economy really isn't starting to slow? The other thing I just mentioned is that first quarter GDP did come in much weaker than what they even expected at 1.3%. I was surprised that they kept it at 2.1% because that's expecting a pretty big bounce during the second half of this year. So I'm curious about that as well.
Vishal, the yield curve is still inverted. It's been inverted for a good long time. We haven't gotten a recession. Do you think that, sort of what Larry is describing does feel like there's a risk? From what you are seeing in rates markets, does that indicate that there is that belief on the part of market participants that the soft landing is not sort of a done deal, that we could still get a recession here?
I think definitely there is that non-zero chance that the market is pricing in. I think the curve probably tells us a little bit more about that hesitancy of the Fed here on their first cut, if you will. So part of it definitely is there. The demand for long end duration within fixed income, especially from the pension community who's been, or LDI community who's been layering into fixed income, moving out the curve, if you will, definitely some technicals have to play in there. We are focused on the other side of the trade. We have steepeners on. We do understand that there is negative carry built into that trade mathematically, how you put those in fixed income portfolios. But we have more probability of that working out versus the inversion increasing, because we do see a very clearly, and I'm going to use a cliche, soft landing sort of scenario that we are playing for here. We don't think that we are entering a recession anytime soon, given how strong consumer and corporate balance sheets are since COVID times, since the stimulus, and then the refinancing wave that went through both consumers as well as corporates in entire of 2021 prior to the rate spike up. So steepeners, we don't predict recession coming. And that also, if I can steal some thunder from my future statements, that's why we are overweight credit in our fixed income portfolios at this point.
Larry, I'm just curious. So the Fed now indicating only one cut is coming this year. Larry, let's say we got no cuts. Would that change your view of the U.S. stock market?
So I think too many people place too much emphasis on whether it's 1, 2, 3, 4, 5, et cetera. I think the more important consideration is what's actually happening to the economy. And I draw the parallel back to when the Fed was raising rates, right? And if you recall, when the Fed was raising it to 3%, people said that was going to be a death knell for the economy. If it went to 4, it was going to short circuit the economy. If it went to 5, it was going to be a depression, right? But the economy was able to absorb that and continue to move. I think you have to keep a close eye on how the economy is doing. So again, whether it's 1 or 2 or 0, as long as the economy remains healthy, I think we're fine for the equity market. But I still think that we're going to need to take some insurance cuts from our base case to make sure that we do avert a recession towards the back half of this year.
Larry and Vishal, thank you so much for your perspective here as we await the press conference. Thanks.
Thank you.
Let's get more perspective on today's decision. We are now joined by Robert Kaplan, former president of the Federal Reserve Bank of Dallas and vice chairman now at Goldman Sachs. It's great to see you. So we've heard from some of our guests today, including Paul Donovan at the top of the show, who said the Fed should be cutting already here. And I thought it was interesting how Larry just framed it as insurance cuts. Do you think the Fed is behind the 8 ball here?
No, I don't. I think they're well positioned. People have to remember that we've got very restrictive monetary policy, but you have pretty accommodative fiscal policy that's blunting some of that monetary policy. That's part of the reason why the economies remain resilient. But I think they've set themselves up pretty well. I think something like 8 participants said 2 cuts. Another group said 1 cut, and even 3 or 4, I believe, said 0. And I wouldn't be surprised if Chair Powell isn't a little hawkish in the meeting, but all he's trying to do is preserve flexibility, and they're getting themselves prepared to act not in July, but very possibly in September, but they want to see a little bit more evidence of improvement.
And listen, Robert, when you talk about more evidence, I mean, we did get that CPI print this morning. That was a good print. That's 2 in a row. What exactly is the Fed watching for, Robert, exactly to get them more comfortable with the trajectory of inflation here?
So we already have goods disinflation. What I'd be looking at is services, and I want to see more evidence that service sector inflation is moderating. I think we're starting to see that. I think they want to see a little bit more of that over the next couple of months. And it's not an absolute bogey, but I think they'd like to see the trend heading in the right direction.
The trend does finally seem to be heading in the right direction when it comes to housing costs. But, you know, when we hear Jay Powell in the past say something like we need to see more good data, how much more? What kind of length of trend are we looking for here?
So there's a couple of things that are working at cross purposes. So service sector inflation, I'm particularly going to be watching labor and labor costs and wages, because that's the biggest part of it. Rents and housing costs is a little bit odd this cycle, in that it could be higher rates are actually making rents higher, in that they're making houses less affordable, they're making multifamily new projects harder to build, and it's affecting supply where people have to rent. And so rents this time around is one of those odd variables that I think the Fed, and if I were there, I'd be watching independently. But I want to see a little bit more rebalancing in the labor market. And I think that's first and foremost to help service sector inflation.
Robert, if I asked you, to take out your crystal ball here and try to forecast when we in fact do get back to the Fed's 2% target, Robert, do you think that's, is that the time frame back half 2024, or no, this is more 2025?
So the most intelligent answer to that question is I don't know. And I would further give you insight. The folks at the Fed don't know. And that's why they're being cautious. Now, why don't they know? If all you had was restrictive monetary policy, I'd have a lot more confidence that we're going to see a slowing in the economy, but we don't have just that. We have accommodative fiscal policy. We've got these open-ended spending programs like the Inflation Reduction Act, CHIPS Act, and the Infrastructure Act. We also have globalization has become deglobalization, which is increasing costs. You have a very expensive energy transition. And remember, we've got an aging society. So we've got shortages of labor, particularly in the service sector. And so how these cross currents play out, there's really not a textbook for. And that's why I think you're seeing the Fed shorten up a little bit on the prognostications, retaining flexibility and being more of a risk manager than a prognosticator. And I think that's the right place for them to be.
That said, though, has the dot plot sort of outlived its usefulness, given that, as you say, we don't know what's going to happen in this environment? So should the Fed pause or even retire the dot plot entirely? And if not, what's the argument for keeping it?
So I think it would be hard for the Fed, having used it now for the last several years, to actually retire it. And I actually would say to your listeners, there's actually an enormous amount of useful information in the dot plot. And I would also caution people, if you're a little curious why they didn't do greater revisions to some of the inflation forecasts and other, remember, they may not have had a lot of time between the CPI this morning and change their submissions, but the dot plot's still useful because it tells me what the debate is around the table. It tells me that there are people that are very forward-leaning and want to cut this fall. There are those that are more risk averse and want to see us wait longer. And there are those in the middle. And that gives you a pretty good sense of the debate. So it's actually pretty useful information. Those that want to retire it say, gee, I don't like all this disagreement. I actually think the disagreement's useful and it's reflective of the debate.
It's interesting because we talked to a guest earlier who said the Fed is too unanimous and that there's not enough debate. But just to dig a little bit more deeply into what you're saying, so knowing that you have that dispersion of the dots, like, how do you interpret that? What does that tell you besides just that there is this debate within the Fed? What do you do with that information?
Yeah. And so I would say, by the way, 2 years ago, they were too unanimous. They should have been moving much more aggressively. Right now, there's a reason that you're going to get unanimous votes. The spread between the actions that they should take is not that wide. The reason for the spread is much more, in my opinion, about risk tolerance, a little less about economics. And so, for example, if I were sitting there, I would say, I'm still stung by the transitory lapse 2 years ago. We're maybe on the 5-yard line and wrestling inflation to the ground. What I don't want to do is see a resurgence. And so I want to err on the side of wrestling inflation to the ground. That's my risk tolerance. There are others that might have a stronger sense that the economy is weakening and they're willing to take a little bit more risk in cutting rates this fall. But that's what this is about. That actually is a pretty good debate and a healthy debate. And it makes sense to me. I think the Fed's pretty well positioned, but there's debate going on in the Fed. People shouldn't think there's not debate. There is.
Robert, I wouldn't be surprised. Jay Powell's about to step up to the mic any minute here. If he gets a question about the election, I know, Robert, he'll say, listen, this institution is independent, but they have to be thinking about it, don't they, Robert?
I think to the extent humanly possible, they're divorcing it from their thinking. They're trying to thread this needle. I think they'd like to get themselves in a position, if the data permit, to act in September. And I think if I were sitting there, I would be screening out any election or political considerations. And that's what I think they'll do.
Robert, good to see you. Thank you so much for your perspective. Really helpful, given that you've been inside the room where it happened, so to speak. Good to see you. Thank you.
Good to talk with you.
And we are awaiting that commentary, the press conference from Jay Powell coming to us in just a few moments here as we await him approaching the podium. But it is interesting to see the sort of reaction that we're seeing in the markets here, where we've come off the boil a little bit from where we were earlier in the session, as investors are trying to figure out, will he give us some direction on where the Fed's going in the second half of the year?
Well, it could be, just like you said, Julie, when he comes to the mic right now, you would expect maybe a calmer, cooler, collected Jay Powell. He's not looking to send the markets into any kind of tizzy.
Right.
And that before,
Yeah.
it seems to have gotten away from that, close to the vest. But yeah, you're going to be looking, I would expect a lot of the same color. Listen, watching the trajectory, data dependent. No, I'm not going to give you a timetable for cuts, no matter how many times you ask.
I think it's so fascinating. We just talked to 4 people, and the opinions of what the Fed is doing and should do are pretty divergent, which I find fascinating. I mean, you have Paul Donovan saying they should be cutting now.
Yep.
You have Robert Kaplan, who was on the Fed, saying they're doing the right thing. So let's hear what Jay Powell has to say right now.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Our economy has made considerable progress toward both goals over the past 2 years. The labor market has come into better balance, with continued strong job gains and a low unemployment rate. Inflation has eased substantially from a peak of 7% to 2.7%, but is still too high. We are strongly committed to returning inflation to our 2% goal in support of a strong economy that benefits everyone. Today, the FOMC decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. We are maintaining our restrictive stance of monetary policy in order to keep demand in line with supply and reduce inflationary pressures. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has continued to expand at a solid pace. Although GDP growth moderated from 3.4% in the fourth quarter of last year to 1.3% in the first quarter, private domestic final purchases, which excludes inventory investment, government spending, and net exports, and usually sends a clearer signal on underlying demand, grew at 2.8% in the first quarter, nearly as strong as the second half of 2023. Growth of consumer spending has slowed from last year's robust pace, but remains solid. And investment in equipment and intangibles has picked up from its anemic pace last year. Improving supply conditions have supported resilient demand and the strong performance of the U.S. economy over the past year. In our summary of economic projections, committee participants generally expect GDP growth to slow from last year's pace, with a median projection of 2.1% this year and 2.0% over the next 2 years. In the labor market, supply and demand conditions have come into better balance. Payroll job gains averaged 218,000 jobs per month in April and May, a pace that is still strong, but a bit below that seen in the first quarter. The unemployment rate ticked up, but remains low at 4%. Strong job creation over the past couple of years has been accompanied by an increase in the supply of workers, reflecting increases in participation among individuals aged 25 to 54 years and a continued strong pace of immigration. Nominal wage growth has eased over the past year, and the jobs-to-workers gap has narrowed. Overall, a broad set of indicators suggests that conditions in the labor market have returned to about where they stood on the eve of the pandemic, relatively tight but not overheated. FOMC participants expect labor market strength to continue. The median unemployment rate projection in the SEP is 4.0% at the end of this year and 4.2% at the end of next year. Inflation has eased notably over the past 2 years, but remains above our longer-run goal of 2%. Total PCE prices rose 2.7% over the 12 months ending in April. Excluding the volatile food and energy categories, core PCE prices rose 2.8%. The Consumer Price Index, which came out this morning and tends to run higher than the PCE price index, rose 3.3% over the 12 months ending in May, and the core CPI rose 3.4%. The inflation data received earlier this year were higher than expected, though more recent monthly readings have eased somewhat. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households and businesses and forecasters, as well as measures from financial markets. The median projection in the SEP for total PCE inflation is 2.6% this year, 2.3% next year, and 2.0% in 2026. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. In support of these goals, the committee decided at today's meeting to maintain the target range for the federal funds rate at 5.25% to 5.5%, and to continue reducing our securities holdings. As labor market tightness has eased and inflation has declined over the past year, the risks to achieving our employment and inflation goals have moved toward better balance. The economic outlook is uncertain, however, and we remain highly attentive to inflation risks. We've stated that we do not expect it will be appropriate to reduce the target range for the federal funds rate until we have gained greater confidence that inflation is moving sustainably toward 2%. So far this year, the data have not given us that greater confidence. The most recent inflation readings have been more favorable than earlier in the year, however, and there has been modest further progress toward our inflation objective. We'll need to see more good data to bolster our confidence that inflation is moving sustainably toward 2%. We know that reducing policy restraint too soon or too much could result in a reversal of the progress that we've seen on inflation. At the same time, reducing policy restraint too late or too little could unduly weaken economic activity and employment. In considering any adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. In our SCP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate, based on what each participant judges to be the most likely scenario going forward. If the economy evolves as expected, the median participant projects that the appropriate level of the federal funds rate will be 5.1% at the end of this year, 4.1% at the end of 2025, and 3.1% at the end of 2026. But these projections are not a committee plan or any kind of a decision. As the economy evolves, assessments of the appropriate policy path will adjust in order to best promote our maximum employment and price stability goals. If the economy remains solid and inflation persists, we're prepared to maintain the current target range for the federal funds rate as long as appropriate. If the labor market were to weaken unexpectedly, or if inflation were to fall more quickly than anticipated, we're prepared to respond. Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. We'll continue to make our decisions meeting by meeting, based on the totality of the data and its implications for the outlook and the balance of risks. The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored. Restoring price stability is essential to achieving maximum employment and stable prices over the long run. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Thank you, Mr. Chairman. Steve Leisman, CNBC. Just wondering if you could walk me through the committee's average inflation forecast. Core PCE is now forecast to be 2.8% by the year end. It's already 2.75, and after today's number, there were several forecasts on the street that it would be 2.6 at the end of this month. Does that tell you that the average official expects no further progress in inflation, and in fact that it's going to get worse? And if you have this wrong, doesn't it mean that you could have wrong the outlook for rates there?
Yeah, so what's going on there is that we had very low readings in the second half of last year, June through December, really, and we're now lapping those. So as you go through the 12-month window, a very low reading drops out and a new reading comes in. The new reading gets added to the 12-month window. So it's just a slight element of conservatism that we're assuming a certain level of incoming monthly PCE and core PCE numbers. We're assuming, good but not great numbers. And if you put that on top of where we are now, you get a very slight increase in the 12-month reading. Now, do we have high confidence that that's right? No, it's just a kind of conservative way for forecasting things. If we were to get more readings like today's reading, then of course that wouldn't be the case. So it's just a forecasting device. I think. Let me say that we welcome today's reading and hope for more like that.
But if it comes in, just to follow up, it comes in the way you forecast it, it would seem strange for you to be cutting rates at all in context of a rising core PCE. Thank you.
Yeah, no, I mean, I think what we said is that we don't think it'll be appropriate to reduce rates and begin to loosen policy until we have more confidence that inflation is moving back down to 2% on a sustainable basis. And that's the test we've applied. I don't know that. I think I don't know that this rules that in or out. I mean, really, it's a forecast, a fairly conservative forecast, month by month, that would lead to slightly higher, 12 months rates by the end of the year. If we get, better ratings than that, then you will see that come down or remain the same. If you're at 2.6, 2.7, that's a really good place to be.
Nick Tamarosa of the Wall Street Journal. Chair Powell, if I look at the rate projections, I see 15 of the 19 that are anticipating either one or two cuts this year, fairly evenly split between the two. And so I wonder if you could explain a little bit more the nuances or the differences there. Would 2 or 3 more inflation readings, like the one that we saw this morning, make a September interest rate cut possible?
So as far as the SEP part of that is concerned, as you know, I talk to all of the other participants on the FOMC every cycle, and we talk about their summary of economic projections and the their dot plot and everything. And what I hear and see is that people are looking at a range of plausible outcomes, and in many cases they're thinking, I can't really distinguish between two of these. They're so close for me. These are very close calls. But we ask them to write down the most likely one, so they do. And I think as you've said, there's 15 of the 19 are kind of clustered around 1 or 2. So I think I would look at all. I look at all of them as plausible. But I'd look at I think that does tell you kind of what the committee thinks. But what everyone agrees on is it's going to be data dependent. No one brings to this or takes away from it, that is on the committee, a really strong commitment to a particular rate path. It's actually just their forecast, and it's a combination of their forecast and their own reaction function. But again, everyone would say that this is very data dependent, and I don't hold it with high confidence. And I think if you're looking for and don't really think that they're not trying to send a strong signal that this is what I think is the right thing. It's just what they think at a given moment in time, subject to data. In terms of future meetings, we haven't, we don't make decisions about future meetings until we get there. I think in terms of what we need to see, I mentioned it earlier, we want to gain further confidence. Certainly, more good inflation readings will help with that. I'm not going to be specific about how many because, really it's going to be not just the inflation readings, it's going to be the totality of the data. What's happening in the labor market, what's happening with the balance of risks, what's happening with the forecast, what's happening with growth. You look at all of that and you ask, are we confident, have we reached an appropriate level of confidence that inflation is moving down sustainably to 2%? Or alternatively, do we see really unexpected signs of weakness in the labor market that would call for a response, which is another thing that could happen. But again, we don't see that. And we see today's report as progress and as building confidence, but we don't see ourselves as having the confidence that would warrant beginning to loosen policy at this time.
And if I could quickly follow up, did you or any of your colleagues change your interest rate projections after 8:30 or whenever you got the inflation numbers today?
So this happens too often, but it does happen. It just is, data came, I think it happened a few meetings ago. So when that happens, when there's an important data print during the meeting, first day or second day, what we do is we make sure people remember that they have the ability to update. We tell them how to do that. And some people do, some people don't, most people don't. But, and I'm not going to get into the specifics, but you have the ability to do that. So that, you know, what's in the SEP actually does reflect the data that we got today, to the extent you can, you know, reflect it in one day. I think we'll, you know, you will see PPI tomorrow. We'll know more about the PCE reading as the month goes on, but the initial CPI reading and its, you know, kind of first level translation to PCE we did have this morning. We were briefed about it, and people were able to consider whether they should make changes. And as I said, you know, some people generally do, but most people generally don't.
John Allen.
Hi, Chair Powell. Janelle Marte from Bloomberg. As you noted, the labor market is now in many ways back to where it was before the pandemic. I wondered if you could comment on how officials are viewing that. So do you think that there still needs to be more cooling in the labor market to bring inflation all the way down to 2%? Or is there any sense that maybe the labor market is more vulnerable now to higher rates now that many of those imbalances have eased?
Sure. So by so many measures, the labor market was kind of overheated 2 years ago, and we've seen it gradually move back into much better balance between supply and demand. So what have we seen? We've seen labor force supply come up quite a bit through immigration and through recovering participation. That's ongoing mostly now through the immigration channel, but still we've had some increases in prime age labor force. In terms of on the demand side, you know, we've seen quits moving down. We've seen job openings moving down. We've seen wage increases moving from very, very high levels a couple of years ago back down to more sustainable levels. We have seen unemployment creep up now 0.6 over the course of a year or so, very, very gradually. So you put all that together, what you have is still low unemployment, still 4% unemployment, historically low. But it's moved up a little bit. It's softened a bit, and you know that's an important statistic. But more than that, you've got strong job creation. You have payroll jobs still coming in strong, even though there's an argument that they may be a bit overstated, but still they're strong. So that's what we see. We watch the labor market, of course, and the economy as a whole, but the labor market very carefully, and that's what we see. We see gradual cooling, gradual moving toward better balance. We're monitoring it carefully for signs of something more than that, but we really don't see that.
As a quick follow-up, the surveys that make up the jobs report are showing different tales. There's been some divergence, especially we saw in the last report that we got on Friday. So how do you interpret that, and how does it change your view on the labor market?
So sometimes you can't reconcile the differences. You just have to look at it and try to understand, and that's why it always makes sense to look at a series, you know, in 3, 6, and 12 months of things rather than just one report. But you're right to point to the last report where there were job losses in the household survey, job gains, big job gains in the establishment survey. So, I mean, we're left with ambiguous results, and we have to deal with that uncertainty around data. Nonetheless, the overall picture is one of a strong and gradually cooling, gradually rebalancing labor market. Job openings, while they've come way down, are still, you know, greater than the number of unemployed people. The jobs workers gap is still a significantly positive number, greater than it was before the pandemic. So overall, we're looking at what is still a very strong labor market, but not the superheated labor market of 2 years ago or even 1 year ago.
Thanks, Chair Powell. Neil Irwin with Axios. Back on the rates path, the SEP showed quite a large shift of rate cut expectations relative to March. That's a period in which the economic data flow hasn't been that dramatic a shift. Can you provide some color on what changed in attitudes on the committee over the last 3 months to see a much shallower path of rate cuts this year?
Yeah, the big thing that changed was the inflation forecast. So the inflation forecast moved up several tenths for the end of the year, and as I mentioned earlier in the, what did we take away from this? We had really good inflation data in the second half of last year, then kind of a pause in progress in the first quarter, and what we took away from that was that it's probably going to take longer to get the confidence that we need to begin to loosen policy. So the sense of that is that rate cuts that might have taken place this year take place next year. You know, there are fewer rate cuts in the median this year, but there's one more next year. So you really, if you look at year-end 2025 and 26, you're almost exactly where you would have been. Just it's moved later because of that progress. Now you get data, different data today. So we'll have to see where the data light the way. You know, the economy has, you know, repeatedly surprised forecasters in both directions, and today was certainly a better inflation report than almost anybody expected. And we'll just have to see what the incoming data flow brings and how that affects the outlook and the balance of risks.
Gina. Gina Smilek, New York Times. Thanks for taking our questions. In the summary of economic projections, the long-run interest rate forecast moved up a bit. I wonder if we should read that as a sign that you think that policy is not sort of as restrictive as we previously expected. You know, how should we interpret what that means about how the committee views its current policy setting?
So two things about that. One is this. You're right, it did move up, but I want to remember to point out that long-run neutral rate of interest is a long-run concept. It really is a theoretical concept, can't be directly observed, and what it is the interest rate that would hold the economy at equilibrium, maximum employment, and price stability, potentially years in the future where there are no shocks. So it's a little bit, it's not something we observe today. Today we've got a very specific economy with all kinds of shocks we're still getting over from the pandemic. So it's, I don't think that the concept of R-star, it's a very important concept in economics and in what we do, but honestly, it doesn't really get you where you need to be to think about what appropriate policy is in the near term. But back to your original question, people have been gradually writing it up because I just think people are coming to the view that rates are less likely to go down to their pre-pandemic levels, which were, you know, very low by recent history measures. Now, we can't really know that. That's an interesting dispute and discussion to have now, but ultimately we think that things like the neutral rate are driven by longer run, slow-moving forces, and you know, there's a really good question about whether those really have changed or whether instead rates and the economy are experiencing a series of persistent but ultimately temporary shocks. That's been the debate. And we can't know. But in the meantime, we're making policy with the economy that we have, with the distortions that we have. And I also, to your other point, I think it is the case that as time has gone by, the question of how restrictive is policy has become one that everyone's asking, and we're asking it too. And you know, my answer has been that policy is restrictive. The question of whether it's sufficiently restrictive is going to be one we know over time. But I think for the reasons I talked about at the last press conference and other places, I think the evidence is pretty clear that policy is restrictive and is having you know, the effects that we would hope for.
Well, thanks, Chair Powell. Howard Schneider with Reuters. Just to carry that a little further, should we read this as a conclusion, the combination of tipping to one cut this year and acknowledging further progress on inflation as kind of a mark to market on the level of restrictiveness that you need, that you in fact have concluded that you weren't quite there yet?
I'd be reluctant to try to draw that conclusion. I think this is about you know, looking at the incoming data and asking how much progress are we making on inflation and how is the rest of the economy doing? Is the labor market still strong? That's what we're thinking about. You know, you can translate it into the language you're talking about, but to me the focus is more on we have a goal which is price stability, another goal which is maximum employment. How are we doing there? We think we've got a good, strong labor market still. We think we've been making progress toward the price stability goal, and then for a while there was a pause, and we look at today's thing and we think, well, that's a good reading, and we hope we get more like that. And you know, in the meantime, we're asking, is our policy stance about right? And we think yes, it's about right. We're prepared to adjust it as appropriate, but we think we're getting the things that we would want to get, broadly speaking. And that's why we've been at this policy right now for almost a year.
So just to follow up on that, I think one curious thing here is you've got now this restrictive policy in place and virtually no change in any of the major things for all of this year. You've got growth that stays above long-run potential throughout the forecast period, unemployment that never goes above the long-run estimate, right, of 4.2. So this isn't a story of slack improving inflation. So where's the improvement in inflation coming from that it's going to pick up pace so much in 2025?
Well, it's been coming. Where's it been coming from? We'll start with that. Clearly, a lot of what some of what we've been getting is just the reversal of the unwinding of the pandemic-related distortions to both supply and demand, and that is complemented by and amplified, supported by restrictive monetary policy. So those two things have been working together. We've also had a very positive supply shock on the labor side, and also you get a positive supply shock when the supply conditions unwind and return to normal. So you've had above trend potential growth and high growth, and yet you've had the benefit of inflation coming down really fast actually last year, and we'll see what the rest of this year brings. So these dynamics can continue as long as they continue. Ultimately the question is are you down to demand? And we don't know that, though. We're look at today's report. If we see more like that, we can't know what the future holds. But in the meantime, we've made pretty good progress on inflation with our current stance.
Michael McKee from Bloomberg Radio and Television. The base case of the committee seems to be that there is going to be at least one rate cut this year, but your growth forecast doesn't see any slowdown in the rest of the year, nor does the unemployment forecast see any significant weakening of the labor market. And your inflation forecasts basically average out to no change. So if at the end of the year there is no change from conditions now, why would you anticipate cutting rates? What would be the point for a rate cut?
Well, we think policy is restrictive, and we think ultimately that if you just set policy at a restrictive level, eventually you will see real weakening in the economy. So that's always been the thought, is that since we raised rates this far, we've always been pointing to cuts at a certain point, not to eliminate the possibility of hikes, but no one has that as their base case. So no one on the committee does. But so that's how we think about it, and that's what we've been getting. That's what we've been getting is good progress on inflation with growth at a good level and with a strong labor market. Now, ultimately, we think rates will have to come down to continue to support that, but so far they haven't had to, and that's why we're watching so carefully for signs of weakness. We don't really see that. We kind of see what we wanted to see, which was gradual cooling in demand, gradual rebalancing in the labor market while we're continuing to make progress on inflation. So we're getting good results here.
Well, to follow up, is there any kind of concern for the housing industry or financial stability, banks, in leaving rates where they are for too long at this point?
On housing, the housing situation is a complicated one, and you can see that's a place where rates are really having a significant effect. Ultimately, the best thing we can do for the housing market is to bring inflation down so that we can bring rates down so that the housing market can continue to normalize. There will still be a national housing shortage, as there was before the pandemic. There will still be one, but the distortions that we see now with lock-ins and things like that, low mortgages. In terms of banks, the banking system has been, solid, strong, well-capitalized, lending. We've seen good performance by the banks. We had the turmoil early last year, but banks have been focusing on bringing up their liquidity, bringing up their capital, and having risk management plans in place. So the banking system, seems to be in good shape.
Chris.
Thanks. Chris Rugaber at Associated Press. I was wondering if we can, on inflation, if you can tell us a little more about where you see inflationary pressure in the economy. You mentioned labor markets coming into better balance, and inflation expectations appear to be well anchored. You're seeing, anecdotal stories of the large chains like Walmart and Target are announcing price cuts. McDonald's announcing a $5 meal deal. So, people may still be unhappy about prices at the grocery store, but it doesn't seem like there's a lot of inflationary pressure left in this economy. I wonder if you could tell us more about it.
I think it's true that inflationary pressures have come down, but we're still getting high inflation readings. So, and I think you can see it in various places. In some parts of non-housing services, you see elevated inflation still, and that's probably it could be to do with wages. Goods prices have kind of fluctuated. There's been a surprising increase in import prices on goods, which is kind of hard to understand, and we've taken some signal from that. But and of course, housing services, you're continuing to see high readings there. To some extent, that's catch-up inflation from earlier pressures. But I mean, overall, you're right. Inflationary pressures have come down. As I mentioned, the labor market has come into better balance. Wages are still running, I would say, above a sustainable path, which would be that of trend inflation and trend productivity. You're still seeing wage increases moving above that. We haven't thought of wages as being the principal, cause of inflation, but at the same time, getting back to 2% inflation is likely to require return to a more sustainable level, which is somewhat below the current level of increases in the aggregate.
Rachel. Hi, Chair Powell, Rachel Siegel from the Washington Post. Thanks for taking our questions. There's obviously a lot of focus on how many cuts could be expected this year, but can you give us a sense of what one cut by the end of the year would actually do to the economy, what you think would be a meaningful difference if there was a cut by the end of the year, or even two?
I think if you look back in 5 or 10 years and try to pull out the significance to the U.S. economy of one 25 basis point rate cut, you'd have quite a job on your hands. So that's not how we look at it. Really, the whole rate path matters, and I do continue to think that when we do start to loosen policy, that will show up in a significant loosening in financial market conditions, and the market will price in what it prices in. I have no way of saying, we're not at that stage, so I don't know what we'll be thinking about at that time. But it's a consequential decision for the economy, and you want to get it right. And fortunately, we have a strong economy, and we have the ability to approach this question carefully, and we will approach it carefully while we're very much keeping an eye on downside economic risks should they emerge.
And you've been talking about this clear sense that it's just going to take longer to have the confidence that's needed for rate cuts. Is there something about what happened in the first couple of months of the year that you're seeing differently now with more time or hindsight? Do you still characterize it as expected bumpiness or something more lasting that is affecting your policy for the rest of the year?
We always want to avoid the tendency to dismiss the parts of inflation that we don't like and just make it go away. But we had a quarter where inflation was running higher, and yes, I could stand here and say it's stuff we shouldn't have taken signal from, but it is what it is. You have to, low inflation is low inflation, high inflation. So if you have a quarter where it's higher, we tried not to take signal from the first couple of months, but we got a third month, and we said, okay, the signal we're taking is that we think it's going to take longer to get confidence that inflation is moving sustainably down 2%. That's what we said. I think that was the right thing to do. I still think that's the right thing to do. Now we have today's inflation reading, which is very different, very much more positive. We're going to have to see what the trend is, what's going to be the data going forward. We're looking for something that gives us confidence that inflation is moving sustainably down to 2%. And readings like today's, that's a step in the right direction. But one reading isn't. It's only one reading. You don't want to be too motivated by any single data point.
Jolene.
Hi, Chair Powell. Thank you for taking our questions. I'm Jolene Kent with CBS News. What's your message to Americans who are seeing encouraging economic data but don't feel good about this economy?
I don't think anyone knows, has a definitive answer why people are not as happy about the economy as they might be. And we don't tell people how they should think or feel about the economy. That's not our job. People experience what they experience. All I can tell you is what the data show, which is we've got an economy that's growing at a solid pace. We've got a very strong labor market with unemployment at 4%. It's been a long time since we've had a long stretch of time with unemployment at or below 4%, very long time. We had a period of high inflation. Inflation has come down really significantly, and we're doing everything we can to bring that inflationary episode fully to a halt and fully restore price stability. We're confident that we'll get there. And in the meantime, it's going to be painful for people, but the ultimate pain would be a period of long period of high inflation. It is people who, lower income people at the margins of the economy who have the worst experience, who experience the most pain from inflation. So, it's for those people, for all Americans, but particularly for those people that we're doing everything we can to bring inflation back down under control.
As just a quick follow-up here, you've indicated one interest rate cut sometime this year, and I know you don't have a crystal ball up there, but a lot of people are watching and see, borrowing money remains very expensive. For everybody who's out there waiting on a rate cut, about when can consumers expect some relief?
Well, I don't have a precise date for you, but what we said is that we want to make sure that we're confident that inflation is actually moving back down to 2%. And when we are, then we can look at loosening policy. So having that kind of confidence that inflation will be at 2%, it just pays benefits to the whole economy, to all Americans for a long period of time. We had that period for a very long time. We very much want to get back to a place where people can not think about inflation. It's just not a concern in the everyday economic decisions that they make. We were there for a long time, and our goal is to get back to that place. And we've made good progress, and we're in the phase now of just sticking with it until we get it done.
Claire.
Claire Jones, Financial Times. Just drawing on the change in the statement on there being modest further progress on inflation. Halfway, through the year and after today's CPI release, what have you and other committee members found that has been particularly encouraging to you? And just in terms of the conservatism, how much of that is about stickiness in shelter inflation in particular? Thank you.
So encouraging has been that growth, the growth clearly that we had last year, particularly the second half of last year, and we continue to see still strong growth or solid growth this year. That's been very encouraging. If you go back a year, there was a real concern about, very much slowing growth and a recession. Many forecasters had that. And that's not what happened. Instead, the U.S. is, anyway, and it's in sharp distinction with many other advanced economies around the world. So that's been encouraging. I would say that today's inflation report is encouraging, but it comes after, several your reports that were not so encouraging. You ask about, your second question was really about shelter inflation. So I think if you go back a couple of years, we know that there are renters, and then there are people who own their houses, and we have OER, which is owner's equivalent rent. And so when market-based rents go up sharply, as they did at the beginning of when the economy reopened, they really went up sharply. Those play into rollover rents much more slowly for existing tenants than they do for new tenants. And so we found now that there are big lags. So there's sort of a bulge of high past increases in market rents that has to get worked off, and that may take several years. Nonetheless, as long as market rents are going up at relatively low levels, and they still are, this is just going to happen. It just is going to happen more slowly than we thought. We also do sort of this thing where we impute a rental value to owned homes, and that's many countries around the world do that. Some do it differently than us. It's something that the price experts have regularly looked at. It is not something that we're the only country that does, and it's not something we're looking at changing or would look at changing, anytime soon. But it's true. It's one of the very hardest things in inflation and in prices is how to think about, the services that someone is getting by living in a home that they could rent, but they're actually living in it. And some countries choose to just ignore that, but that's not how we do inflation here. We do it the way we do it, and we've been very transparent about it. And it's true that we're we're seeing delays in realizing what's happening economically, but we understand that. We understand that very well.
Edward. Edward Lawrence with Fox Business. Thank you for taking the question, Chair Powell. So I want to go back to jobs and the consumer. The last jobs report showed that over the past year, 634,000 more people took multiple jobs. That's up 8.2%. And since January of 2021, we've seen prices rise 19%. So people are using their credit cards to pay for their lifestyle. What pressure points will signal to you that the slowing economy could maybe break companies in terms of hiring or break the consumer in terms of spending?
So, we monitor all the things you mentioned and more. What we're seeing is basically spending was going up faster than disposable income during big parts of last year rather. And so what you'd expect to see is people spending more on their credit cards. That has been happening. Credit card balances have been going up. Credit card defaults have been going up. They're not at high levels. Remember that after the pandemic, people were cooped up. They couldn't spend money. They couldn't go out to spend money. They could spend money from home. But households were in very, very strong, historically strong financial shape. They've now worked off a lot of that. So we're watching that carefully. And, what do we see? That's what we see. We see the same data that everybody else sees, but you've still got household sector that's in pretty good shape. But nonetheless, it's not in the kind of shape it was in a year or two ago. And we're carefully watching that.
So how close then are we to that point where the consumer can't continue to spend as it's spending, or companies can't hire like they're hiring?
Consumer spending is still growing. It's not growing at the pace it was growing at a year or so ago, but it's still growing solidly. And by the way, other parts of the economy are picking up. Spending on equipment and intangibles has picked up quite a bit in the wake of all the construction that we saw of new tech plants. So overall, the economy is exhibiting solid growth, and something around 2%, which is a good pace of growth for the U.S. economy. But you're right, though. We do see the same thing other people see, which is increasing financial pressures on more lower income people, and the best thing we can do is to foster a very strong jobs economy, which we think we have done. Ultimately, to get inflation under control, because those people experience inflation, very directly, very painfully, and once we get inflation under control, rates can come down, which will also improve things.
Victoria. Hi, Victoria Guida with Politico. You've mentioned that an unexpected weakening in the labor market would bring rate cuts sooner, and I was just wondering, can you talk a little bit about what that would look like? Is it more of like a quicker pace of people losing jobs? Is it more the level of the unemployment rate if it were to start to go above 4.2 or something like that? How are you thinking about what you're looking for to see the job market unexpectedly weaken?
When I say unexpectedly, the first thing is more than kind of is in our forecast or in common forecasts. So something more than that. But we'll be looking at everything. The labor market has the ability, has the tendency sometimes to move to weaken quickly. So waiting for that to happen is not what we're doing. We're watching very carefully. We're looking at the balance of risks. I always point out the balance of risks. So and also the fact that we look at all of the whole situation. So a decision to begin to loosen policy could have several reasons associated with it at a given time. But I would just we monitor all the labor market data, and if we saw troubling weakening more than expected, then that would be something we'd consider responding to. But we look at the broader context of what's going on too.
So something like negative payroll numbers would be.
I'm not going to. I mean, I can think of things that many things would make it on that list, but I don't think I'll butter them here.
Thank you, Chair Powell. Simon Urbanovich with The Economist. May I ask, you mentioned with the slightly higher PC readings earlier this year that it wasn't 1 or 2 months, but 3 months that tipped you to be a bit more cautious in the rate outlook. Should we take from that it looks like May will be quite good for PC as it was for CPI? Does that imply that kind of 2 more good months would reinstill the confidence that rate cuts could be coming sooner than you currently project?
I don't actually have that kind of mechanical thing in my thinking. I get that, as many good ones as we had bad ones, but no, it's not like that. It's going to be the totality of the data. The labor market data, the growth data, in terms of inflation, you'd want to see real progress that builds your confidence that we are on a path down to 2%. And I don't want to try to give you specific numbers of things because that points to dates, and I just don't think we're not at a point of being able to do that.
Kosuke.
Thank you for doing this. I'm Kosuke Takami with Nikkei. I would like to know about the impact of stronger dollar on U.S. economic growth and prices. And I have no doubt that the market should determine the exchange rate, but Japan and some emerging markets are suffering from the strong dollar. So I want to know if it is having a positive impact on U.S. economy in total. Thank you.
So we don't, actually it's our finance ministry, the Treasury Department, that has a responsibility for thinking about and if it sees fit, doing things about the level of the dollar. So for us, it's just another financial variable. And you're right, the dollar has exhibited some strength over the course of the last year or so because the U.S. economy is very strong. We don't think of it as benefiting or hurting the U.S. We don't manage the level of the dollar. That's not our job. It's not, and for our economy, what we're trying to foster is maximum employment and price stability, and we feel like we've made good progress on both of those goals over the course of the past year.
Jennifer.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. You said you would cut rates before inflation falls to 2%. You're forecasting inflation to end the year at 2.8% on core PCE, or at 2.8%, of course, on core PCE. Right now, you said the inflation forecast is conservative and that if you got 2.6 to 2.7 on PCE, that would be a good place to be. You also indicated the job market has mostly normalized. So why not cut rates this summer just once? You're well above neutral, to try to preserve the soft landing rather than risking waiting too long in the quest for confidence for inflation.
So we're well aware of the two-sided risks here. Let me just say we understand that if we wait too long, that could come at the cost of economic activity, of employment, of the expansion. We understand that if we move too quickly, we could end up undoing a lot of the good that we've done and have to then start over, and it could be very disruptive. So we're extremely aware of both of those risks and just basically trying to manage them. And what we said is that we don't think it'll be appropriate to begin to loosen policy until we're more confident that inflation is moving down to 2% over time on a sustainable basis. That's kind of been our test. Or there's another test, which is an unexpected deterioration in labor market conditions. So I think that's the right way for us to think about it. That's our dual mandate there, and we have a strong economy. We've got growth. All forecasts are very commonly around 2%. That's a strong growth rate for our economy. The labor market continues to print jobs at a pretty high rate. Unemployment's still low, so we have the ability now to approach this question carefully, and that's what we're doing.
And just to follow Chair Powell, do you need to be ahead of a weakening in the labor market? Otherwise, is it too late, given that the labor market is a lagging indicator, right, when you look at the monthly jobs data?
Yeah, we completely understand that that's the risk, and that's not our plan, is to wait for things to break and then try to fix them. We're trying to balance these two goals in a way that is consistent with our framework, and we think we're doing that.
Evan.
Thank you, Chair Powell. Evan Reiser with Market News International. You have mentioned before the framework review process will start in the latter half of the year. At this point, do you have any specific time frame for the start of that? Who will lead it? Will it be you or a committee group of your peers? What will be the parameters? Do you anticipate the review will consider changes to communications going forward?
So what we've been thinking is that we would announce and commence the review later or late in the year. In the meantime, as that time approaches, we will be devoting a lot of careful thought and planning to the contours of it. Within scope would certainly be communications generally. I'm not going to say that we'll look at this or that particular thing. And all the other details, we don't want to get prematurely into a conversation until it's really time to have it. And so, I'm going to leave pretty much everything else to later in the year.
Go to Nancy for the last question.
Hi, Chair Powell. Nancy Marshall-Genzer with Marketplace. Just one more question on housing. Can you still cut rates with shelter prices high, or will you wait until they start to moderate a bit?
I wouldn't. There isn't any one variable like housing prices moderating that would really decide against what we're doing. We've got an overall test, which is greater confidence that inflation is moving down to 2% on a sustainable basis. That's our overall test. Or alternatively, we see unexpected weakening in the labor market. So those are two different tests. I would say, we're not looking at any one price in any one sector and saying that's the one. We don't target housing prices, for example. And we don't target wages. We target aggregate prices and overall employment. So,
but if housing prices remain sticky, could that slow down the pace of rate cuts?
I think you look at we'd be looking at the aggregate numbers and asking ourselves what's going on here with inflation at the aggregate level. And of course, if any price that contributed to ongoing inflation would matter. Any price that contributed to ongoing disinflation would matter too. But I wouldn't single out housing as having a special role there. Thank you very much.
Welcome back to Market Domination. We just heard comments from Federal Reserve Chair Jay Powell about the Fed's decision to not cut rates, as well as some commentary sort of around the dot plot, the summary of economic projections. He did say we're waiting for more good data, which is what we talked about him potentially saying here. And he is talking about that the Fed is still focused on the need for inflation to come down more, the pace of inflation, before the Fed is ready to act. And he said in answer to a question from our Jennifer Schomburger that the Fed is well aware of risks on both sides. In other words, of not acting and of acting, and the pitfalls of each. And
I thought it was interesting too, Julie, just some of the reporters in there pushing him on core PCE, which of course is Jay Powell's preferred inflation gauge, and how the forecast for Q4 this year had actually got revised up by a tick to 2.8%. We're at 2.75, and so he was pressed there, kind of what gives there, and Powell's saying we're assuming a certain level of incoming monthly core PCE numbers, assuming good, he said, but not great numbers. So I think that explains that. He did add, by the way, this is kind of, he was sort of emphasizing a forecasting tool. It's a forecasting device that he's using here. So maybe he's suggesting not a high degree of confidence. And that the Fed, he said, did welcome, of course, that cooler than expected CPI print we got this morning.
Yeah, and it was interesting because he sort of said, the Fed kind of learned its lesson last year because they were excited, inflation was coming down, and then it sort of stalled out. Yeah. And so emphasizing that there is a lack of predictability here that's a factor. For sure. And the Fed doesn't know anything more than the rest of us do.
Some art, some science, maybe. Yeah. Well, let's get to Jared Blickery now for a check on the markets. Jared.
Josh, I got to tell you, we didn't see huge movements in this press conference, and I think that's a good thing for investors. Let's tick down the charts here. Here's the Dow. You can see it's up a whopping 30 points here, or 8 basis points. And what you'll notice is we started on the day on a green note. We drifted down into the red by 2 p.m. and just got a little bit of a jolt downwards. But then we are off of those lows, not a lot, but mildly in the green. Here's the S&P 500, and you can see this is a different chart. Stayed at the highs all day day long and still right there. And then we also have the Russell 2000, which is up 2%. And this just came a little bit off of its highs, but for the most part, we're going to say that's a really bullish looking chart right there. And we got to check out what's happening in the 10-year T-note yield. And you're going to see this downdraft right here. That was on the CPI report this morning. You go back 2 years, 10 years, it's CPI that drives the market a lot more than these Fed days. So that's an interesting development as well. Here's the US dollar index. You're going to see that heading down. Again, this was CPI, not the Fed. This is the Fed in here. So let's take a look at our charts and look at this. Tech up almost 3%. Been a while since we had a big day like that, but also consumer discretionary. That's the home of Amazon and Tesla. Both of those outperforming. Let's get a read on our new bellwether leader of the biggest stock in the world, Apple. That is up 5.62% in the upper left. NVIDIA, not to be left out, that's up 3.5%. So the mega caps just flying. And check out Tesla. Tesla up 5% too, guys.
Jared, thanks a lot. Appreciate us. Now let's talk more about the Fed reaction to the markets with David Bahnsen, Chief Investment Officer at the Bahnsen Group. David, good to see you here. So it seems like markets pretty pleased with, well, not just the Fed, but also the CPI data this morning. What's your reaction?
Well, I think it's more that the market was relieved that there wasn't bad news. I mean, it's good news, and the bond yields are really the greatest proof of that. But it's the traders and speculators that have to front run whether or not it goes the other way. And that's what the big spike at the morning open was about. And so you get 300 points just as a lot of these hedges and various positionings come off. And then now you kind of go back to normal. And what is normal? Normal is the fact that the Fed's not going to raise rates again, that the Fed's going to cut once or twice this year, and that earnings are good in the market, and that the market is expensive. That's all the normal, and we know all that day by day, but some of these things just require a little bit of extra trading volatility around them.
And David, just the reactions and the responses are now coming in from economists. I want to get your take. Ian Shepherdson over at Pantheon, he says, listen, it's kind of calling the Fed's bluff. He says the Fed's going to have to backtrack from this new dot plot. He says, bottom line, he sees the labor market softer over the summer. He thinks core PCE, it's going to come in better than Jay Powell expects. He's still looking for that first easing in September. And then he's telling his clients, I think the Fed's going to have to play kind of scramble to catch up here. What's your reaction to that, David? What do you think?
Well, the Fed has already had to adjust its dot plot, but the other way a couple times this year. And I don't disagree with Ian that it could happen, but my expectation now is that they won't cut in September, but they will still take out 50 from the curve by the end of the year. And the reason for that is because they couldn't cut in July. I think they would have cut a second time in September, but not a first time, because now it's just too close to the election and it's only 25 basis points. It's totally immaterial in the real world. And so why go do a quarter point right before the election and make them have to hear all the nonsense about it being political? They'd rather just wait and get their 50 basis points out of the curve in November and December. That's my expectation.
So, David, of course, you're not the only person who said that the election is a factor in the Fed's decision-making process. Of course, we heard on the other side from Robert Kaplan, former Dallas Fed president, who said as much as they are able, they try to divorce themselves from those political discussions. It sounds like you don't buy it.
No, I do, and I understand what you're saying, but that's kind of the point I'm making, is that because I think they want to be divorced from the political, that's an argument for why they will just wait. In other words, this could cut either way.
Even the appearance of
cutting. They can be accused of cutting for political reasons, and they can be accused of not cutting for political reasons. My point is that once you get to 4 to 5 weeks before the election, and by the way, absentee ballots are already going to be being cast at that point, I don't think any of it would be substantively political. I agree with Kaplan about Powell and the Fed mentality there. I'm just referring to the optics that I think there's no upside in doing it when they can just wait. I think the FOMC meeting, by the way, in November is the week of the election. They can act 24 hours after the election and accomplish the same thing with their monetary policy aims.
And Dave, one thing you said there, they cut once in September by 25 bips, and that wouldn't be material. It was sort of interesting, Dave, in the conference to listen because a reporter pressed Jay Powell on that. She kind of asked him, why would that matter? One cut in September, and I don't know if he gave it an exact answer, but he sort of seemed to suggest, it's not the one cut that matters. It would be that we've started on the path. It's the rate path that would have an impact. What's your response to that?
No, I agree. I thought it was a great question, and I think his answer is basically right. But what I would say is they put us on that path last November. And what I mean by that is even though they haven't been cutting, they told us they're done raising rates. They told us they're ready to cut. And that's how you got multiple expansion from 20 to 24. That's how you got the 10-year from 5 down to 4. That's why credit spreads are 300 wide when they were in 2022, almost 600 wide. So they've basically kind of forecasted what they were going to do. And then the path actually begins with action. And look, we started off the year believing it'd be March. Now we're talking about whether it's September or November. And don't get me wrong, if they end up cutting in September, then I'm just wrong. And it's not going to shock me. I'm more referring to the fact that I think September and November are interchangeable at this point in terms of policy outcome.
So, David, between CPI and the Fed presser just now, we got stocks climbing again. I mean, the Dow's down a little bit, but the S&P and Nasdaq are at record highs again. Is there anything between here and the end of the year that creates a major speed bump for markets?
It's a great question because the major things that asset allocator and portfolio manager like me is supposed to think about are not things that can be forecasted, so-called unexpected events. Is there a possibility in the second half of the year of downward earnings revisions into 2025? There is the possibility. Is there a possibility of upward earnings revisions? Yes, but a couple percent at the most, soaking wet. So I think that the risk is asymmetrical. Geopolitical issues are out there. Volatility around our own U.S. election is out there. But the biggest issue, by far, is one we know about, and that's the multiple of the market. That's the fact that NVIDIA is a third of the market this year, and it's trading at 75 times earnings. That the S&P is at 23 times forward earnings right now. It's just an expensive market. That's the biggest thing we have to watch for the next several months.
David, it was great to have you on the show. Thanks for making time to chat.
Thanks for having me.
The Federal Reserve leaving interest rates unchanged and signaling only one rate cut this year. Fed Chair Jerome Powell reiterating the central bank's need to gain greater confidence on inflation. Yahoo Finance's Jennifer Schonberger joins us now with more. Jennifer.
Good afternoon, Josh. That's right. Fed Chair Powell telling reporters during a press conference just moments ago that the Fed needs to see further encouraging readings on inflation to gain greater confidence, though he said it also is about the holistic picture of the economy. What is the state of the job market? What is GDP? What is growth? It's not, he wouldn't commit to a set number of inflation readings to gain that confidence. Take a listen to the chairman.
So far this year, the data have not given us that greater confidence. The most recent inflation readings have been more favorable than earlier in the year, however, and there has been modest further progress toward our inflation objective. We'll need to see more good data to bolster our confidence that inflation is moving sustainably toward 2%.
Powell also said that there's not a lot of confidence that he has in their forecast for inflation. They revised their forecast for inflation up to 2.8% from 2.6% previously. He says committee members erred on the side of being more conservative, getting good, not great readings. And when you look at the comps over the past several months last year versus this year in the second half of this year, they're going to be a lot harder. So they're erring on the side of being more conservative. That opens up the door for potential surprises to the upside, or the good side, if you will, when it comes to inflation. And so it sort of calls into question whether the SEP for one rate cut is too conservative if we get more good readings like the one we saw on the Consumer Price Index this afternoon. Guys.
Jennifer, thanks so much. Appreciate it. Coming up, while the Fed once again held rates steady, the updated dot plot lays out their moves to come in the future. We're going to take a deeper dive when market domination returns.
While the Federal Reserve holds interest rates steady, investors dissecting the Fed's updated projections on the economy and path for rate cuts. Yahoo Finance's Alexandra Canal joining us here with her interpretation of what we know as the dot plot.
The dot plot, Julie, and yes, Fed officials now expect just one rate cut this year. That's down from the 3 that was projected in March. The Fed funds rate is expected to peak at 5.1% in 2024 before coming down to 4.1% in 2025. And if you bake in that one cut that is expected this year, that implies 4 rate cuts to come next year. Of course, that's only if these projections hold true. But I want to zoom in on 2024 because it feels like we're more aligned when it comes to the path forward for interest rates. However, we did get some split views on whether or not we're going to see that one cut this year or possibly 2. So 15 Fed officials believe that we'll see some sort of cut. 8 thinks that's going to come in the form of 2 cuts. 7 believe just 1 cut. And then we have 4 officials up here that think interest rates are going to remain steady, remain where they are. No officials see any rate hikes. So that's, of course, encouraging here. Now, heading into this release, markets are pricing in between 1 to 2 cuts. And following that cooler than expected inflation print that we got this morning, along with those comments from Fed Chair Jerome Powell, there seems to be increased probability that that first cut could potentially come in September. But I mentioned inflation, and we did get some other economic projections from the Fed. And it seems like it's going to be a bit longer until we reach that 2%. Consumer prices did show further cooling during the month of May, but the Fed expects inflation to actually tick higher than previously anticipated to come in at 2.8% in 2024. That is expected to come down in 2025 before settling in at that 2% level in 2026. Another area of the economy that the Fed has been very focused on is that hot jobs market. The unemployment rate is currently at 4.0%, and the Fed expects that 4% unemployment rate to remain in 2024. However, we're going to see some slight upticks in 2025, and then we'll settle at 4.1% in 2026. And then finally, let's take a look at economic growth, GDP. That seems to be the same as what the Fed projected in March, so 2.1% this year, and then we're going to settle at 2% growth in 2025, and it's going to remain at that level in 2026. And then the longer run here, we have 1.8%. So of course, these are all projections from the Fed. They frequently are changing, but all in all, markets seem to be digesting this very well with stocks up, and then we're also on track for another record close for the S&P along with the Nasdaq. Josh, Julie.
Allie, thank you. Let's get to some trending tickers now. Shares of Zillow and Home Depot, both on the rise, comes after this morning's consumer price index data, coming in a little cooler than expected in hopes that rates are going down. So that was really the name of the game here, Julie. You just had this kind of these moves in these rate sensitive names, right? So we mentioned digital real estate. Zillow was one. Redfin, Opendoor. I saw all those guys moving earlier. Zillow, we should note also, by the way, director did disclose late yesterday, 100 million in share purchases. That never hurts, of course.
Yeah.
Also some home improvement names too got a lift. Home Depot, Lowe's.
Yeah, Build First Resources I saw was higher. SoFi was another one. Like basically anything at all that there was the perception that lower rates would potentially help them. And it's interesting because these stocks are maintaining their gains even after we heard from Jay Powell. He didn't seem to indicate that those lower rates are coming imminently, right? And the expectation is still not that they are coming in July. I was struck by what he said when he was asked about how inflation is affecting Americans and how the Fed is sort of weighing the costs of these rates where they are versus the benefits that would come if they were cut. And he said, we want to make sure we're confident that inflation is moving back down to 2% because he says it pays benefits to Americans, the whole economy. He says he wants to get back to where people don't have to think about inflation, right? That it's front and center. And so it's interesting that we're not there yet, that they, he knows, he acknowledged people want those lower rates. They want also lower inflation. So.
Yeah, and he kind of emphasized there, Julie, it's a good point. He also talked about, kind of pulled on that thread about how we got to get this inflation down. Particularly, he said, painful for lower income Americans especially.
Yeah.
But your point, these continue to pop. I'm just looking at the ETF that tracks the home builders, the XHB, about 3.2% right now.
Yeah, in many of the cases of the stocks that we just showed on the screen a few moments ago, I don't know if all of them, but most of them are down on the year going into today. Zillow, for example, down 26%, and even with today's gains, is still down on the year. Home Depot down on the year, SoFi down on the year, Builders FirstSource down on the year. So these are stocks that have really been suffering as we have had what's been going on with the with rates. And I was just eyeballing Zillow's shares versus Treasury yields, because the common sense would be they would move inversely, right? When yields are higher, there's the perception that the home building market is going to be hurt, and that is what we've seen. It's not as quite as clear on that particular chart, but there is a sort of rough, there you see it there as well, a rough inverse relationship.
Yep, for sure. All right, let's move on to another one, Julie. Shares of Canadian Western Bank.
Sure.
Oh, sure. Skyrocketing. This coming after the news that the National Bank of Canada agreed to buy this bank for about $5 billion Canadian dollars. One interesting note, I reached out to the team at Raymond James, and they cover this. One sort of interesting note I saw was, so National Bank says this deal should close by the end of 2025. And Raymond James is sort of interesting. They said, and they cover the names, of course, and they said it kind of makes sense to them strategically. It's a logical fit. I thought one thing they said was interesting, the timing. So that will be kind of during what they say is going to be kind of this federal election year. And the analysts saying there could be sort of Western-based institutions and politicians in Canada in the middle of an election that may not be, so crazy positive on their domestic bank being acquired. So maybe some kind of possible political cross currents on this one.
Interesting.
Yeah.
I mean, if you look at the Canadian market, obviously we are not super familiar with the Canadian banking market, but there are really 5 big banks in Canada, and National Bank is one of them. I should say there are 5 in Toronto, and then this one based in Montreal. And so now they're making a regional purchase here. The folks over at Bloomberg Intelligence did say the deal is expensive, but is consistent with another Canada banking deal that happened this year.
Well, neither of us are that familiar with the sector, but maybe it's a trip to Montreal.
Okay.
Enterprise report.
I'm in.
Okay.
All right, still to come on market domination. Apple has reclaimed the title of world's most valuable company. Can it keep its seat on the market cap throne? We will talk about the latest moves in the tech sector on the other side. Apple has reclaimed the title of world's most valuable company. The tech giant's market capitalization surpassed that of Microsoft earlier today after Apple's AI announcements ignited investor enthusiasm and drove the stock to a record high. But it was a little bit of a delay, right? It was a little bit like of a delayed reaction. But what we have here are the market caps of every stock in the Nasdaq 100. Here you have Apple, $3.283 trillion. Microsoft, $3.273 trillion. And then you got NVIDIA, which is in third here, $3.089 trillion. But these two basically switched today for the first time in a while.
Yeah, it's been, we were talking off camera about this, and I wonder how much, Julie, is almost a kind of relief as well here. Like the big question was, what is this company's AI strategy, right? What is the vision? And Tim Cook, at the very least, came out along with Craig Federighi, their software chief, and said, here it is. Here's the vision. Here's the strategy. Here are the features that are coming. And I wonder if there's some relief there. At least you have clarity. And then when you see a move like this, there just has to be.
Let's look at this move in a little more detail here. So here's the price today.
Right.
But let's pull it out and take a look. Let's say at the 3-day chart, right? So this was Monday when they first came out with those announcements. Then, of course, we saw the lift yesterday.
Look at that.
And then there's the lift again today. So the 3 days now equals a 9% gain.
Are there just more people now betting that what we heard is going to really motivate some meaningful upgrade cycle? You know,
maybe that's what it is. I mean, as I wrote in this morning's morning brief newsletter, it also might be a numbers game. When you look at the vast numbers of people who have iPhones, you're talking about an install base of something like 1.5 billion people estimated. Even if not all those people are getting these AI upgrades today, it'll just be iPhone 15 and above, the new one that's coming out in the fall. That's still a lot of people using it in their daily lives, and we could finally get a feel for what AI is good for on a personal level. It feels like we know what it's for in enterprise to some degree, but we don't really know, like, how do we use it on a day-to-day basis? Maybe this is a discovery process for that.
Which I think is a great point, because maybe that's what Tim Cook is also thinking. It's such early days. I can partner with Sam Altman and his team at OpenAI, and I can still just take this time to learn a ton about how people use this AI tech, what they like, what they don't like, right? All useful down the road.
Well, all of it now is equaling a stock that is now positive again on the year and bigger than Microsoft. Let's talk more about this move that we've been seeing, because analysts have been cheering Apple's AI announcement. It's a little mixed. It took a little bit a beat for them to get excited. Shares initially slid after Monday's keynote before surging to record highs the next day. Joining us now is Antoine Caibon, who is New Street Research Technology Infrastructure Analyst. Antoine, good to see you again. So what do you make of this sort of delayed reaction that we got in the Apple shares to all the announcements?
Yes, hi Julie, thanks a lot for having me. So yes, I would say that the keynote on Monday was boring and inspiring at the same time, because on one hand, they presented exactly what the iPhone experience should be when it comes to using Siri in general, figuring out a plan, combining like a Uber trip and a boarding pass, an address and a calendar entry, etc., etc. All these experiences are at best frustrating today, and all suddenly appeared very sleek and very pristine in the keynote on Monday, but that's kind of a deja vu, right? And on the other hand, it was exciting because we thought it articulated very well the promise of generative AI at the core of the operating system. It really has the power of redefining the way we interact with technology. Content, creation tools with like instructions coming in as natural language, context now being taken into account as well in the way the OS interacts with the user. Creativity with the OS generating content and executing tasks, supposedly with minimal instructions. So yes, that's why our thoughts were mixed when we watched the keynote on Monday. And I think the stock reaction also reflected that originally. Now, I think it also shows the fact that Apple is working very hard on all this. And I think the fact that it could drive a product cycle is still an open question. It's maybe what is driving the stock now. Maybe this is what is giving confidence. The market is getting confidence in the fact that it could drive a product cycle. Maybe that's what we're seeing in the stock right now.
But you think, Antoine, you think it's too soon to say about whether it's going to drive a product cycle?
Yes, because I mean, I really don't really have a good answer for you, because on one hand, you have Apple Intelligence that will only be compatible with the products that are based on the A17 Pro and M1 chips and above. So that's maybe about 10% of the Apple active installed base. So if features are well received, it could foster replacement because it's only 10% that's compatible. But on the other hand, it's a big if, because for now, we're not really convinced that on-device AI will enable game-changing user experiences, because the hardware simply is not game-changing. You don't really see an inflection point, in like the AI compute that are in the phones. It's growing, of course, but there is no inflection point. And since GPT-4 is anyway available readily on most iPhones through the ChatGPT app, the question is, do users really need to upgrade to use that technology? The answer so far is not really. So we'll have to see if the integration with the operating system is really a game-changing experience.
So Antoine, put all that together. What do you think that means for further upside or not for Apple shares?
Yes, so if you take a step back on all this and look at the Apple stock, so I think the stock is fairly valued. Reality is that growth has peaked on most fronts. iPhone peaked in December 2021, Mac in September 2022, with the share gains over 2019 to 2022 driven by Huawei being phased out in China, and the move to in-house silicon is now mostly behind on the Mac front. Then you have iPad that peaked in December 2020, with the installed base growth now slowing and refresh cycles elongating. So then if you look at services, they're at an all-time high, and that's driven by the App Store, that's driven by licensing, the deal they have with Google. And that collection of businesses will likely continue to grow in double digits in aggregate, but we see limited room for an acceleration here as well. So bottom line is that Apple has maybe a mid to high single digits growth outlook, and it's trading at a very significant premium to the S&P, to S&P names with a similar growth profile. So yes, we still have little conviction on a product cycle driven by AI, as I was mentioning earlier. So put all that together, and that's why we're neutral on the name.
You do note, Antoine, I want to get to this, that the keynote, Apple's keynote, was music to the ears of ARM. How come, Antoine?
Yes, well, if you look at the implications of the event, like a second order derivative for the broader technology infrastructure supply chain, there's ARM, but Apple is likely going to have to pay OpenAI to get GPT-4o in iOS, and we estimate that Apple would incur a cost of about $10 per device per year. So in the near term, if it's only 10% of the 2 billion devices installed base, that's $2 billion per year in total, $2 billion per year in total. But over the long term, if all the installed base starts using extensively models like that, it would cost Apple maybe $20 billion on a full installed base of 2 billion devices. And so if they want if OpenAI wants to have access to enough compute to support such a large installed base, they themselves and Microsoft will have to buy a whole lot of GPUs. So they would have to spend maybe tens of billions of dollars on GPUs. So first of all, before we talk about ARM, that really reinforces our positive bias on NVIDIA. And then for ARM, well, it pushes up ARM-based silicon content inside the phones, because you have the model, part of the technology is powered by on-device inference. And so that's obviously positive for ARM. And then since it's a positive for NVIDIA, and as you know, the Grace CPU that NVIDIA is going to be selling with Blackwell, that they're already selling with Hopper, is also based on the ARM instruction set architecture. So that's also a positive for ARM.
Antoine, super interesting take. I appreciate your time. Thank you so much for joining us today.
Thank you.
And while we're wrapping up today's market domination, don't go anywhere. We've got you covered with all the action following the closing bell, including the latest earnings from Broadcom. Stay tuned for Market Domination Overtime.
There's the closing bell on Wall Street. Now it is market domination overtime. We're joined by Jared Blickry to get you up to speed on the action from today's session. And an interesting session it was. Starting, Josh, with this morning's CPI coming in milder than expected.
Second good print there.
Second good print, so showing momentum going in the right direction in terms of deceleration in inflation. And then we got a Fed that didn't change rates and said we're still waiting for more good data in that direction.
Data dependent.
Exactly.
Right?
So the Dow down about 36 points on the day after all of that. But the S&P 500 up 0.9, closing at a record. The Nasdaq up 1.5%, closing at a record. Want to take a look at some other asset classes real quickly too, because the 10-year note reflecting those sort of pulled back expectations for rate increases. So off 11 basis points, pretty big move there in the 10-year. The dollar down as well on the day. And then just glancing at some other stuff, I know we've been watching Bitcoin. Not doing much, went up and then came back down again, I guess, and crude oil trading a little bit higher. And then the other thing I wanted to check real quick, and this is something we were just talking about, all the activity we're seeing in large cap tech today.
Yeah.
It's really interesting to see those moves.
Do you think Jay Powell sees this? You know, he's probably calm, cool, collected someplace. It's kind of, listen, job well done. I didn't send the markets into a tizzy. I've done that before. Didn't do it again. I played it kind of calm and cool. I kept it close to the vest.
Listen, as people like Rick Reeder of BlackRock have pointed out, this is sort of a double-edged sword for the Fed, because the fact that stocks keep going up, the fact that also rates are still at relatively high levels, means that the wealthiest Americans are worth more and have more to spend.
Makes
and
his
can
job
keep and can
perhaps
keep
more
a base
complicated.
under inflation, maybe. But I did want to point out as well, all of these guys over here. All closing at records today.
Big tech.
Microsoft, Apple, NVIDIA, even as Apple regained its market cap position above Microsoft, all of them at records. ARM, which we were just talking about with Antoine a few moments ago, at a record. TSM, Taiwan Semiconductor, at a record.
Wasn't it interesting just to talk to the analyst? I thought it would be kind of like what he called the second derivatives out of Apple's keynote for NVIDIA, for ARM, right? Which didn't ARM record today? Was that?
Yes, record as well. Exactly. So a lot of activity in big tech as well for all of this. Let's go over to Jared now for a closer look at today's action.
Well, thank you, Julie. Let's stick with the Nasdaq 100 and bringing it behind me. I'm going to show you something interesting happened earlier today, and then I'll move on to our sectors. But Microsoft lost the top spot. It was Apple. They switched positions, something like that. I'm not going to be telestrating for the NFL here, but you get my drift. It changed by the end of the day, so there's going to be some headlines probably as Apple reclaims that top spot and potentially loses it. And we're looking at the sectors as well. 3 sectors outperformed today. Tech, by far and away the leader, up over 2%. XLY, that's consumer discretionary, up 1%. And industrials, pretty close to that as well. To the downside, energy and staples, both down over 1%. And taking a look at our leaders, guess who the #1 winner was? Home builders. You don't see that very often, but that is potentially an interest rate play. Also taking a look at chip stocks, SOX is #2, regional banks, Korean stocks. So a lot of broad strength, but tending to be in some bigger names, some bigger sectors, and with home builders. We haven't seen that in a while. So I guess I'm just a little bit surprised here.
Jared, thank you. Appreciate the update. Federal Reserve dialing back its expectations for the number of rate cuts this year, now at 1. It comes on the heels of a cooler than expected reading on consumer prices. The S&P 500 and Nasdaq closed at records. Joining us now is Mark Howard, BNP Paribas Managing Director and Senior Multi-Asset Specialist. Mark, thanks for joining us.
Thank you very much.
So we'll start, Mark, just the news of the day. Give us your take, Mark, on what the Fed did and said today.
You know, there's a lot to digest. Unusual doubleheader with CPI and the Fed. I think the bigger news today was, frankly, the CPI than the Fed. The Fed did have the information at its disposal that went into its projections and its dot plot, but the real mover today, as you saw in market action, was CPI, which helped long duration equities like the tech stocks you were just talking about, brought yields down. 10-year Treasury and 2-year Treasury all rallied. And it opened the door, perhaps, to a September rate cut, but then the Fed came in later and said, you know, not so much. It's probably more like December. So that was the narrative today, but it was a very positive day, as you mentioned, for most of the equity market, most of the bond market, and so that sets a kind of a clear path for the next month or two.
So you interpreted Jay Powell's commentary today to say it's more likely December than September. What in his commentary sort of pushed you in that direction?
Well, it was not just his commentary, but certainly, Julie, he did make it clear that they're not yet comfortable enough with the sustainability of inflation readings down close to 2%. And you actually saw that in a revision upward of their core PCE forecast for the full year. So that's one indicator. The second was the change in that dot plot, that median dot plot, and the fact that the overall board is now, the median is now for just one cut this year instead of previously they were looking for 3. So when you go from 3 to 1, you're basically pushing everything back. They did add 1 to next year in their projections, but as we all know, the out years are kind of highly suspect.
Mark, I'm just curious, when you think about the Fed's path here, whether they do 1 cut or 2 cuts or 3 cuts, does that influence and impact, Mark, how you think about the U.S. stock market and kind of, the near to intermediate term?
Yes, it does, because, Josh, we're at all-time highs. It's not like we're kind of treading along in the middle and rate cuts are kind of a marginal thing. The valuation paradigm is somewhat based on the expectation that rates are not going to go higher. So if we entered the day expecting 3 cuts and we're leaving the day expecting just 1 cut, then we're that much closer to the rates actually not getting cut at all. And that matters to valuation, that matters to general sentiment. But as I said before, it's not just about the cuts, it's about the data. And the data are what are going to determine when the cuts come. And the CPI data was positive today.
We keep talking about the disconnect between the economic data and consumer sentiment, but I'm also curious about the seeming disconnect between the market activity and market sentiment. You just mentioned sentiment. Stocks are at records. It doesn't feel like a risk-on environment, like a super bullish environment right now. Or am I wrong? It's interesting to see stocks continue to creep up without anything seeming to be fantastic.
Yeah, no, that's a very fair assessment, Julie. There's not froth in the markets. We're not seeing a lot of excesses in the form of, there are a few, meme stocks that are, bouncing around, but by and large, we're not seeing a ton of M&A. We're not seeing a lot of equity offerings. We're not seeing some of the signs that, that give us a fear of froth. It's really just a solid economy with an expectation that rates are going to come down and that will add a second leg. And so valuations are full, but there's not a ton of excess. You're absolutely right.
So does that mean, though, that if you do see a pickup in something like M&A, that then that can give another lift to, or some of those other elements you're talking about, not froth, but that can give another leg up to the market?
Most certainly. I think a lot of Wall Street is anticipating and hoping that we see a pickup in what we call animal spirits, and the IPO market is an example, M&A is another. The problem is that the elections in the U.S. are kind of an impediment to M&A, and so that's something where I think a lot of corporate execs are going to want to see what is the most likely outcome with regard to tax policy in terms of the potential for incremental fiscal. Will it be here? Will it be there? And importantly, trade policy. So if you want to embark on an M&A transaction, something strategic, those are important variables, and you don't want to enter into it just 6 months before the goalposts move.
So when you get those questions right now, Mark, from your clients about the election, first of all, how often are you getting those questions? And then what are you telling them? What's your advice?
So it's a terrific question, and it's not just about the domestic election. It's globally there are important elections: Mexico, India, France, et cetera. Clients are starting to ask more questions, but to be honest, and we just had a big conference for our institutional clients on markets a month ago, and the focus was definitely on inflation, the Fed, AI, things that are really tangible and investable today. But there's a growing awareness that the narrative may shift, and that electoral noise and the potential policy implications of one party or another controlling Washington could shift. But people are not really putting on big trades that I'm seeing among major institutional investors yet. But they're starting to ask the question. They're trying to anticipate which sectors may benefit or not benefit from anticipated policy changes. And we'll see, with the first debate coming up pretty soon, more clarity around what some of those policies may be.
And Mark, you don't just focus on stocks, you focus on multi-assets, as your title implies. What is the asset class that we're not talking enough about right now?
Well, I think commodities have taken a back seat, and people are not talking as much about commodities, I think, generally, because the tech sector, as you were just alluding to, has stolen the show, and the Fed has made the bond market kind of exciting. But I think the credit markets have been chugging along, have been generating solid returns, and there's a broad menu of opportunities in traditional cash credit, in private credit, in structured credit, securitized credit. So the credit markets are another area. I mentioned commodities because they're at the foundation of a lot of the big themes that are happening, whether it's around AI and the need for more technological bandwidth, more data centers, more everything related to core AI, but also around energy transition. There's been a lot of focus on the different picks and shovels that go into energy transition, however you want to define that. But at the foundation, there's copper and there are other commodities that are really important to that. So I think that's another area where I think people are shifting their attention from the first order is NVIDIA, second order is Microsoft and Apple, and then further down the line is the commodity complex. And some of those companies have a lot to offer.
Mark, thanks so much. Good to see you. Thanks for coming in. We want to talk about another top trending ticker to see how it closed the day. We were talking all about all these large cap tech stocks that closed at records. Here's another one. Oracle is leading the pack after announcing cloud deals with both Google and OpenAI, and those shares closing at a record today with that big increase that we saw. Now, we talked about the stock a little bit yesterday because it came out with earnings, but what really got attention was the company's partnerships that it just announced with OpenAI, with Google, with Microsoft. And so even though its results were sort of lackluster, people were really focusing more on that.
Yeah, and Larry Ellison, never at a loss for words, Ms. Johnson, says the world's largest cloud companies and the world's most successful and accomplished AI companies choose to use Oracle Cloud services and data centers. Evercore's Kirk Materne, who knows the company very well, covers it in the space, says Oracle's position in the public cloud, he did tell clients this morning, continues to get stronger. And to your point, Julie, he says that announcement that OpenAI is now going to be using OCI only adds, he says, to Oracle's credibility as this kind of AI platform. I think we just kind of saw investors react to that. Kirk, by the way, reiterated outperformed, took his target to 160.
Yeah, and it sort of has to do with the sort of different speeds of different parts of the business. Bloomberg Intelligence saying that these deals are likely to accelerate growth in that cloud infrastructure business, which could help offset a slowdown in the broader cloud portfolio.
Yeah. We get Larry Ellison and Safra Katz on the show.
Sure.
That's an open invitation. Open invitation. Coming up, with Tesla shareholders set to vote on Musk's controversial pay package tomorrow, what could be next for the CEO? We're going to discuss with a shareholder when market domination overtime returns.
maker Broadcom out with second quarter earnings. The share's up a quick 8% because guess what? Another stock split from another big chip maker here and a quarterly dividend of $5.25 a share. The company announcing a 10-for-1 forward stock split as it comes out with its earnings. Let's get to the earnings as well. Earnings per share of $10.96, beating estimates by 16 cents a share. Net revenue at $12.49 billion, beating estimates of $12.06 billion as well. So beating across the board here, it looks like. And the company also coming out with a full year revenue forecast for about $51 billion. That's above the $50.5 billion that analysts had been anticipating. Now, I can't remember who it was this week. I'm sure you will remind me who said Broadcom was one of the other best ways to play AI in chips, that this was a good
I can't remember,
way to
you
do
know
it.
who does pound the table on this name a lot and says that is our friend Stacey Rasgon at Bernstein.
Yes, I think that's
Loves
who it was.
Broadcom.
We did talk
yeah.
to him earlier this
and,
week.
And it's always said, to your point, I mean, Stacey's been on the show and he's been a believer for a while and has always said to us this is, one of the top, in his opinion, top ways to play AI in the space.
Yeah. And if you look at the results here and what the company is saying in its statement, they said the results were once again driven by AI demand and VMware. Now, this isn't just a chip maker, we should say, because VMware is visualization software, so the company's software and chips here. But the company said revenue from our AI products was a record $3.1 billion during the quarter, and infrastructure software revenue accelerated as well as more enterprises adopted the VMware software stack. That, according to Hock Tan, the president and CEO of the company. And so they raised that guidance for 2024.
Yeah, to your point, Julie, it's good because I think a lot of people still think Broadcom. They think semiconductors, wireless, infrastructure, networking. But, Hock Tan has moved them hard into higher margin software. And look at that. I mean, this stock was already a huge run into this print, now higher.
And by the way, quick note on the stock split here. That will be effective as of July 15th on the open of trading.
All right. Meanwhile, Tesla shareholders voting on CEO Elon Musk's controversial pay package, and we'll get the results tomorrow afternoon. Moments ago, CalPERS, by the way, announcing it voted against it. Yahoo Finance's Alexis Keenan here to discuss some of the pros and cons that shareholders are weighing. Alexis.
Yeah, so kind of a mixed bag we're getting from a variety of influential shareholders. So it's still kind of a wait and see, even though Elon Musk had teased us a little bit in that tweet or X post saying that 90% of the retail shareholders that have voted so far wanted a yes for his pay deal. So let's kind of talk through the things that might be weighing on shareholders' mind for the pay package, against the pay package. One big one, of course, incentivize Musk to stay as CEO of Tesla. There's arguments, of course, for many years that he is essential to the company, that he is synonymous with Tesla, that he needs to be there in order for the company to be successful long term. Also, maybe avoiding a lawsuit from Elon Musk. Now, I don't know what nature that lawsuit might take, but if he's not paid, look,
lawyers will think of something, Alexis.
They're creative. They'll think of something. And he has not been paid since 2018, since this is a all performance-based package. So one could make the argument perhaps he's got to be paid something. We don't know what that would look like in the future if this is turned down. Also, looking back to 2018, the deal did get 73% of independent shareholder support back then. So you could say that's a relatively high number, even if you don't like the way that the board processed the deal and served it up to shareholders. And finally, on the side for the argument for pay, avoiding maybe a stock price decline. There have been plenty of analysts that say if you don't vote for it, that Tesla stock is going to suffer.
Well, and it already has suffered, of course. It's already gone down. Okay, so give us the other side.
Okay, the other side, a no pay vote in favor of that theory, avoiding, let's say, shareholder litigation. You could make the case that either way this vote goes, that some shareholders are not going to be happy. They could say that there's harm to the company's value if it loses the 40 to 50 billion, plus that it might have to pay Elon Musk if this deal is a yes. Also, maybe just punishing the board of directors for their approach to analyzing the pay deal. The revote is recommended by a one-member compensation committee. So, that's not necessarily a ton of detail, though the company holds out that they did put this rigorous analysis to come up with this redo, this copycat version of the 2018 deal. Also preventing Musk from increasing his control of Tesla. This would give him another approximately 12% of the company. And he has said that he wants that at least 25% control in order to continue as he has been in the past. And finally, just diluting company assets. That's been one argument out there from some proxy advisors, saying that they don't want those assets to go toward Elon Musk, or at least maybe not in that volume. Yeah.
All right. Thank you, Alexis. We wait and see. Viewers can head over to the Yahoo Finance homepage, by the way, to vote themselves on if Musk's pay package should be approved. Currently, a whopping 96%, Julie Hyman, of voters are signing with no. Look at that.
And there's a lot of votes there as well. What, almost, I think, more than 400,000 votes. Now, who knows if those people are actually shareholders, right? Or if they're representative. I mean, today we learned that one big shareholder was not going to be paying for the pay package. That was CalPERS, the California retirement system. There's also CalSTRS, which represents some California state employees as well. Between those two, the state of California overall has about 14 million Tesla shares. So it is a significant voting block. So, you know, who knows? We don't know how it's going to go. But there have been some big names like that, significant shareholders that have come out and said they're voting against.
All right. I think we're going to talk to another shareholder.
Yes, we're right now, in fact. And while we're awaiting this decision from Tesla shareholders on Elon Musk's pay package, our next guest says it is a nightmare lose-lose situation for shareholders. Joining us now, Ross Gerber, the CEO of Gerber Kawasaki Wealth and Investment Management. It is good to see you, Ross. You, like the folks at CalPERS, you plan to vote no, or if you already vote, have you already cast your vote?
I already voted no. Yeah.
Gotcha. So lay out your case for why you're not approving this pay package.
I mean, it's mostly have to do with the board of directors being so negligent in not only, not, doing the compensation committee and the proxy and the way that typically compensation is done at every other public company other than Tesla is by independent committees of the board working with the CEO to come up with a comp package that is two-sided. This was not what happened at Tesla. It was just Elon presenting his comp package and them saying, sure. And, when it gets shot down by the court because of the lack of corporate governance, then the response is, well, let us now explain how we came to this. Let's vote on this again. Then we're going to go back and appeal and say, see, the shareholders still want this. And it doesn't actually address the real issue, which is that still nobody negotiated with Elon on this pay package. And it's possible he would have agreed to maybe half the size of the pay package to, let's say, 25 billion instead of 50. And, that would have still been a massively excessive amount of compensation. So that's why I'm voting against it, because I just think this causes more problems than it solves. And I think the board should craft a real compensation package for Elon with an independent board the way that is required by law.
When you say a real compensation package, Ross, any thoughts on what that would look like to you?
Well, once again, I'm not against the basic structure of stock options and such. And, I don't think Elon needs much incentive in the sense of he owns, 80 or $90 billion worth of Tesla stock. At the time of the comp package, he owned $10 billion of Tesla stock. So he's made about, 70 to 90 billion in gains irrelevant. So, we throw around these numbers, but in the real world, the average American makes $65,000 a year. And so when you actually think about that, we're talking about a compensation package for the wealthiest person that's ever lived, it's the stupidest thing I've ever heard. Like, it's literally so dumb that this is the focus of Tesla and not selling cars as we get to the end of a quarter where they're going to miss all their numbers.
Miss all their numbers here, but they did make their numbers during the period in question that we're talking about, Ross. I want to talk about...
It went from zero. I mean, you're making numbers from zero, yes.
So, this is a legitimate car maker now at a time when, you go back in time, there were a lot of people who thought that Tesla wasn't going to make it. But let me leave that aside.
But we've all benefited from that, including Elon.
Let me leave that aside for a moment, because I am curious what you think would happen if indeed the no's like you succeed here. What then is the scenario? Does Elon step back from the company, for example? Does he take his AI tech to, somewhere, to one of his other properties?
Well, there's two sides to this. One is I think he already has stepped back from the company, and that's been going on for 2 years now. And then he just eliminated every meaningful executive at Tesla over the last 6 months. So he put Tesla in a position where if we don't vote for him and he, let's say, threatens to leave the company and leaves the company, there's actually nobody at Tesla to run it. So he's done this while the board is, again, closed their eyes and been fine, as he's just let go a ton of, really talented long-term executives at Tesla for one reason or another. So, Tesla's in a really bad position, because Elon put Tesla in that position to the benefit of XAI and X and his other investments. So right now he's told us that he wants to build AI outside of Tesla. He's moving chips from Tesla to XAI. It seems like there's a disconnect between what's actually happening, which is an absent CEO who's doing what's best for AI, for him to control it, versus what's best for Tesla. And the board of directors isn't willing to step in and say, hey, this isn't what's best for Tesla. So the issue to me is, if the vote fails, how is he going to retaliate against Tesla? I mean, this is absurd for somebody who's the majority owner of the company. I mean, it's an absurd conversation. He should be doing what's best for Tesla no matter what. And
Ross, besides,
so it doesn't matter what the vote does. He's got 90 billion in the company.
Well, so what's besides sort of further, enabling the board, in your view, if he succeeds in this vote, what are the other downsides of him getting this vote to go his way?
Well, I kind of think the vote's about 50-50 right now. Like, I would flip a coin. I don't know what it's going to do. If it does pass, the good news is we can just go back to litigating this comp package, as it will be relitigated, I'm sure. And the shareholders will be responsible for $25 billion of taxes on this that, he'll have to liquidate stock to pay, and shareholders will bear that cost. So as long as shareholders are fine with, obviously when that happens, it will be a detriment to the value of the company. So it's really expensive to pay somebody $50 billion. So, that's the shareholders paying him. So, does he deserve it or not deserve it? We could debate this till we're blue in the face. I don't think anybody deserves $50 billion for running a company for 5 years, but that's just me.
Ross, when did you first get into Tesla?
I got into it in 2014 when it was a $2.50
So that's a nice return under Mr. Musk there.
That's right. It's a wonderful return. And let's not forget, if it weren't for the US government loaning Tesla money, and if it weren't for investors like me and other institutional investors that stood by Elon through this period of time, Tesla would have gone bankrupt like 5 times. And in 2018 in particular, I supported Elon at the most crucial time in Tesla history. It was literally all these people on Twitter who think they're such big fans weren't nowhere to be found in 2018, except for Ross Gerber. And so, I'm out there helping Elon, helping Tesla succeed. Now, it's a small part of the overall story for sure. And Elon built a wonderful company. But as I said, he benefited the most of anybody from Tesla's success. And all of us, rest of us shareholders, rightfully benefit along with it. And that's how companies work. But that said, I think Elon deserves compensation. I'm not saying he doesn't deserve to be compensated. What I'm saying is they need to go out doing these things the right way. And the right way is by having a negotiation that's fair. The typical CEO makes $20 million a year, but he's not the typical CEO. So let's look at a guy like Steve Jobs when he came back to Apple. He got 7.5 million share option. The value was substantially less than anything Elon's even looked at. And, actually, Steve Jobs didn't have any stake really in Apple when he came back. So it was like they had to give him incentive. So, there's precedents for founder CEOs that are incredible innovators with option packages as well. And I think the board should work hard to come up with something fair that will compensate Elon for the past and the future and be defendable in a court of law.
Well, we'll see if that happens, Ross. Thanks a lot for joining us. Great to catch up with you as always.
Thanks for having me.
And be sure to tune in tomorrow. Yahoo Finance will be having special coverage of the Tesla shareholder meeting as investors await the decision on Elon Musk's pay package. Be sure to tune in between 4:30 and 5:30. We will be covering the shareholder meeting. We'll be tracking the vote. We'll be talking to big investors like Kathy Wood, who has been a supporter of Elon Musk. It will be quite interesting.
Looking forward to it.
Yes.
That is going to do it for today's Market Domination Overtime. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell. But don't go anywhere. On the other side of the break, it's asking for a trend. Stay tuned. Hello and welcome to Asking for a Trend. I'm Josh Lipton. For the next half hour, we're going to be breaking down the trends in today that'll move stocks tomorrow. There's a lot to keep track of, so we're focusing on what you need to know to get ahead of the curve. Here are some of the trends we're going to be diving into. Great Fed expectations. The Fed leaves rates unchanged at its June meeting, but now expects just one cut in 2024. The decision coming after encouraging inflation data this morning, though Fed Chair Powell stressed more data was needed before a policy change could come. Plus, all it takes is a little AI. Oracle shares hitting a record high today. That's after announcing a string of AI contracts and partnerships with Google Cloud, Microsoft, and OpenAI. But one industry insider warns big tech may be writing AI checks that software companies can't cash. And a record year for convenience store chain Casey's. Company's fourth quarter earnings blew past estimates thanks to what it called a discerning but resilient consumer searching for value. The CEO is going to join us with more on how the company is winning with inflation-weary consumers. But let's start with those markets. The S&P 500 and tech-heavy Nasdaq closed at a new record. Investors digesting cooler than expected inflation and the Fed's latest policy decision. Here with more on the trading day takeaways, let's get to Yahoo Finance's Allie Canal.
Hey, Josh. Well, you said it. Once again, new records for both the S&P 500 and the Nasdaq. And I want to start here with the S&P. It is the 28th record close for the S&P so far this year. Right now, we're trading at around levels of 5,400. That is already above most year-end targets for those analysts and strategists, which is crazy since we're already 6 months into the year. I was joking with our markets reporter, Josh Schaefer, that we're probably going to get more upticks on that when it comes to those year-end targets. UBS and BMO have around 5,600. So definitely more room to run at that front. I'm just going to refresh this a bit. But when you think about the Nasdaq as well, 16 record closes for the Nasdaq so far this year. And then I want to take a look at small caps. This is an interest rate sensitive area of the market. We mentioned that cooler than expected inflation data. We know that the Fed is projecting at least one cut this year. We saw small caps finish the day in the green. And then finally, let's take a look at the 10-year Treasury note. This was shortly after that inflation print, falling 11 basis points
Back to
trade
4.3,
near 4.3%. So we'll see where things go from here. But overall, a pretty positive day in the market, I would say.
Yeah, well, I mean, listen, you listen to the Fed and rates unchanged, but also I think you got that CPI print this morning. That was two good prints in a row, and Jay Powell telling you, at least I think how the Fed put it, they're making kind of modest progress on their inflation target.
Right, and related to that, all of that is fueling odds of a September rate cut. So, you know, we did have only one cut from the Fed. That's what they're projecting. That is down from the 3 cuts that they projected in March. And although that's less than what the markets were anticipating, Fed Chair Powell in his presser didn't necessarily shut down the option of potentially having 2 cuts. And if you take a look at the latest data from CME Group, 61% think that we're going to see some easing beginning in September, and that is up from just a day prior. And like I was mentioning with those Fed projections, it was pretty close. About eight Fed officials think that we are going to see 2 cuts. 7 think we're going to see 1. So it's a toss-up at this point when it comes to how many cuts that we'll see. And it looks like the markets are thinking maybe 2, with the first one coming in September.
Yeah, interesting. We had, you know, economists and some of the pushback, Al, you're already seeing on some of this. Some thinking, you know, we'll see how that goes, whether they might have to backtrack on some of that dot plot, but we'll see how the data goes from here for Jay Powell.
Right, and that's something that Jay Powell continuously stressed. And then finally, my third point, Apple briefly surpassing Microsoft in market cap. They weren't able to finish the job, but look at how close this is. Of course, this comes after Apple's artificial intelligence announcements. Apple, the stock seeing the best 2-day performance since November 2022. So something to keep track of, something to keep an eye on, especially as Apple struggled at the start of this year, but now we're seeing it neck and neck with Microsoft.
You got to think some of that is investors must be betting that what Tim Cook said is going to drive that product cycle.
Yeah, it was interesting because I feel like it was a mixed bag on the street with how important or how much this is going to move the needle for Apple moving forward. But you don't really want to bet against Apple when it comes to this stuff.
All right, Allie, thank you. Appreciate it.
Thanks.
The AI hype is alive and well, as we were just discussing, both Oracle and Apple hitting record highs today thanks to artificial intelligence deals with OpenAI. And joining me now is Craig Walker. He's the founder and CEO of Dialpad. Craig, it is good to have you on the show. Maybe quickly, Craig, you know, for viewers who might not be familiar, just describe a little bit about your company, the mission, and the problem your tech is trying to solve for, Craig.
Yeah, Josh, great to be here. Thanks for having me. Yeah, so at Dialpad, we have an AI-powered customer intelligence platform that really takes all of business communications and analyzes it in real time. So a contact center call, how to provide better support, one of your sellers making sales calls, how to close better with real-time coaching, and then how to analyze trends of, you know, what is customer satisfaction for certain things, which sales motions are working better than others, and really using that entire communication stack to make your company smarter and do better at their jobs.
And Craig, we are in this AI moment. You just heard us talking about Apple and Oracle. So Craig, walk us through how is your company leveraging that technology?
Yeah, so when you think about it, you know, I used to run the Google Voice product, and we started this company about 14 years ago, and it was all about making the most modern communication platform. And 6 years ago, we acquired a real-time AI company to build that into the core of that offering to understand what's actually happening in the conversations. Now that you fast forward to the modern day with all this generative AI and these large language models, we're sitting on our own 6 billion minutes worth of training data and have built our own large language model to understand business conversations and to be able to give advice price in real time. So the real trick is understanding what's happening on a conversation. How do you use that understanding to make your customers happier, make your prospects buy more, help your recruiting team recruit better, and just basically let everyone in the company be more productive. So the AI is a real application in that contact center, sales center, recruiting space.
And when you talk about AI, Craig, of course, and you guys obviously are sitting on a ton of data. There's always immediate questions about that data, the security, the privacy. How do you navigate that, Craig?
Yeah, so one of the most important things of owning your own large language model specific to your industry or specific to us, business communications, is since we own it, it sits within our servers, within our infrastructure, and we're not sending it off to some third party to go analyze it. So by having that built in-house and running in the core of everything we do, it keeps it much more secure. It doesn't go off to any third party, and it really is being trained on your own data as well. So it's actually more accurate, it's faster, and it's more secure when you own it yourself.
And Craig, maybe just a broader question too about this moment we find ourselves in, because there are people, Craig, that say, listen, what you're witnessing here is a paradigm shift. I mean, really, it's internet, mobile, and now AI. Do you believe that, Craig?
Absolutely. I mean, you've seen other transitions in the past, like moving from on-premise to the cloud, and you'd have these cycles where, early adopters would move quickly, and then other CIOs would wait to see how it plays out, even over, a decade or more. And that's not going to be the case with AI. Like every head of IT, every large organization is under a mandate from their board and from their management to use AI, to deploy AI, to make their teams more effective and make their company more competitive. And CIOs these days are not going to have the luxury of sitting around and waiting to see how it plays out because your competitors are doing it. You're under the gun to do it. And you see that in budgets too. The budgets are going to the AI-powered solutions and not to the legacy ones. So it is a real, it's like last year was the year of hype around AI. This year is the year that AI becomes real. And then next year and beyond is the year the winners start to really, really monetize the AI.
All right, that's when we can distinguish between the winners and just the marketing fluff. Craig, I wish we had more time. That was a great conversation. Thanks so much for joining us.
Thanks for having me, Josh. Appreciate it.
You got it. Coming up, shares of Casey's General Stores, they are soaring. Look at that, over 16% today following their latest earnings report. I'm speaking with the CEO on the other side to check in on the state of the consumer. Stick around, much more asking for a trend still to come. On Wednesday, convenience retailer Casey's announced fourth quarter results. The company beating on revenue and blowing past EPS estimates. And joining us now to discuss is Casey's CEO, Darren Rebelez. Darren, thanks for joining us.
Thanks a lot, Josh.
Let's start there, Darren, because you reported you beat the stock, ripped higher. Just walk us through the quarter. What drove the business?
Yeah, we had a couple of things. We had a great quarter, but first I'd just like to give a shout out to my 45,000 teammates in our 2,600 stores. They really executed at a high level this quarter, so that was certainly part of the secret sauce behind the quarter. But we really saw a lot of strength in our prepared foods business, and if you don't know, we're actually the 5th largest pizza chain in the U.S. So we have 2,600 stores. All of those stores have kitchens. We make pizza from scratch every day, and had really strong growth in prepared foods, up almost 9%, same store across there, and that was driven by a couple of things. We launched a thin crust pizza platform last summer, and we're still cycling over that, and really good growth there. And then more recently launched a new lineup of hot sandwiches where we were up 85% in the quarter in that hot sandwich lineup. So that really drove the traffic. And then I would say just up and down the P&L, the team just executed on every single element of the P&L. And when you put all that together, it results in the kind of quarter we had.
Pizza, hot sandwiches. Darren, also I want to get your take, as you have really unique insight, perspective on the consumer. What's your take on the consumer right now in terms of what you're seeing? How healthy, how resilient?
We're seeing pretty good resilience with the consumer at this point, and that's across income brackets. Now, what we are seeing is on the lower income consumer, they're starting to shift behaviors. They're still spending money, but they're spending it a little differently.
How so? How are they spending differently?
I'll give you an example. Yeah. I think it's been pretty well reported that candy prices have gone up because cocoa prices have shot up. So candy has become expensive. Well, we have baked goods that we prepare in store every day. So we're starting to see low-income consumers rotate out of candy, but into cookies and brownies and our baked goods. It's a little more affordable indulgence. They're satisfying their sweet tooth. They're just doing it in a little more economic way.
What about, I also want to get your take on gas prices. What average retail price now, Darren? What is it now versus a year ago?
In our footprint, we're averaging about $3.08 to $3.10 a gallon. That was probably a dime higher last year, so not significantly higher. And really, we're not seeing the change in behavior that we sometimes do when gas prices get real high. We'll see consumers, when they're high, shift into more higher blends of ethanol because that fuel tends to be cheaper. They stop buying premium fuel. We're not seeing any of those behaviors right now. So I think the consumer has kind of said they're okay with gas prices right now, but then they're being a little more discerning as inflation starts to pinch their wallets a little bit. And so they're deciding where they want to shop and where they spend their money. And we're really positioned well from a value perspective, and so we're starting to see more traffic come into our store.
Any changes you all are making kind of inside the store, and inside the stores, like new levers you're pulling, innovation?
We've done a lot of that over the last several years, and really re-merchandising our stores. We've got a really robust private label program now with over 300 items in the assortment. More recently, we got into the liquor business in terms of private label, and our Frost Trail vodka, our own proprietary vodka, is the #2 selling vodka, only behind Tito's in our stores. And so the private label team's done a really nice job of broadening out that assortment, and that just offers a more affordable, high-quality alternative for our guests.
I want to get you out of this because I'm interested. Mostly focused in Midwest traditionally,
but
you all are now moving into Texas. How much of an opportunity is that?
Well, Texas is a really big state, as you know. We just made a small acquisition, 22 stores in North Texas, but as I like to say, everything from the I-35 corridor to the Mexican border is Casey's country. So I think we got a lot of runway to grow.
That sounds like a lot of widespread. Taryn, thank you so much for joining us. That was great. Appreciate it.
Thanks a lot, Josh.
And coming up, I'm going to tell you everything you need to know to kickstart your Thursday. Stick around. More Asking for a Trend on the other side. There's no hiding in recent years the poor performance from value indices. However, there's more than meets the eye when it comes to the big picture with value investing. Yahoo Finance's Julie Hyman joins me now with a closer look. Julie.
Yeah, and today's chart of the day, courtesy of Michael Kantrowitz over at Piper Sandler, who really had this note digging into the seeming value underperformance. This is something we've been talking about recently, right? We talked about the Bank of America yesterday. Thinks that value is going to start to catch up to growth. We've seen that underperformance in recent years. But Kantrowitz says we are framing it incorrectly. When we use value indices, he says, to measure this performance, that's why it looks so weak. So what he does, among other things, this note had a lot of charts, but among other things, he looks at the value index, right, the Russell Value Index, which is underperformed, and this goes back all the way to January of 1996. And then he looks at individual stocks that he defines as value or being looked at through the criteria of value factors, which is just another way of saying in financial jargon criteria in order to screen for certain stocks. And in this case, he's looking at low PE, low price to earnings ratio stocks, and shows that they've actually performed just fine. He quibbles with the construction of the value indices. That's the reason why that the value performance looks so weak. And he talks about how, so I mentioned the value indices tend to overweight things like financials and underweight things like technology. In other words, if you look within technology, there are stocks that you would define as value, but because you're looking at it through a sector lens, you get just things a little bit out of whack. So he says if you look at the value factors across sectors, being sector agnostic, you get a better picture of what value really is, and that the performance does not look as weak. So he makes this case, as I said, through a number of different charts. This is just one of them, but it was an interesting look that perhaps it's the criteria that those indices are using in their construction that is part of the reason that value we tend to think of it as doing much worse than growth.
Yeah, Julie, correct me if I'm wrong, wasn't it Michael Kantrowitz who's on our show pounding the table for utilities? Am I remembering that right? Was that Michael?
You are remembering that right. And utilities is one of those areas that typically, traditionally falls into the value bucket. That is a low PE group overall, right? So that's one of the groups perhaps he'll talk about. He's doing a call on Friday where he's going to give more details about all of this. But definitely financials tend to fall in that bucket as well. But he says in this note, you shouldn't think of necessarily those sectors as value sectors anymore. You have to think of what value means in a more holistic fashion.
All right, Julie Hyman, thank you. Time now for to watch Thursday, June 13th. All eyes will be on results of the Tesla shareholder vote tomorrow. Two focal points: CEO Elon Musk's $56 billion pay package and the decision to move the company's incorporation from Delaware to Texas. CalPERS, by the way, announcing today it will vote against that pay package. It owns more than 9 million shares. Yahoo Finance will have live coverage of the results tomorrow starting at 4:30 p.m. Eastern. And moving closer to the economy, the latest producer price index for May is coming out in the morning. Economists forecasting both overall PPI and core PPI to cool compared to April. The new print giving us another key piece of economic data and coming after the Fed just left rates unchanged earlier today. Fed Chair Jerome Powell reiterating that the Fed needs to see more good data to reinforce confidence in inflation. And finally, we're going to get some earnings tomorrow, including Adobe, RH, and Signet Jewelers. Adobe reporting second quarter results coming after the bell. Analysts expecting the company not to raise its full year sales outlook. That's a wrap on today's Asking for a Trend. Be sure to come back tomorrow at 4:30 p.m. Eastern for all the latest market moving stories affecting your wallet. Have a great night.